Good morning, welcome to Trade Live with IG with myself and City AM Special.
Good morning, Rich. Pleasure to be here.
It is Thursday, the 7th of August, 7, lucky number 7. And sorry for the delay, everybody. We had a network issue, which Mini Cooper's also got.
Yeah, well, Mini Cooper's on it. He's calling tech support, harassing them. He's getting it fixed.
Yeah, he's all over it. Although we don't call him Mini Cooper anymore. Now he's Big Luke.
I've always called him Big Coops because he got a bit sensitive when I called him Mini Cooper, and I respect my friend's feelings.
Look at that beautiful morning out there. Oh, we can't lie.
Tropical.
But yeah, beautiful day yesterday.
Beautiful day yesterday, especially if you were long the Americans.
Long the Americanos. Let's have a look at what's coming up on today's show. We've got myself and Ronnie through till 10 past 8. Then Angeline is taking Ronnie on. But look, just look, 8:25. You read it there right. The man is back. The first time Andrew Webley was on this show, the company must have been worth about 200 million sterling, I think. Now, worth 600 million sterling. Andrew Webley joins us at 8:25 to go through the latest Smarter Convert. 9 a.m. all sessions opening bell with Angeline. Then we've got Psychology of Trading with our favourite Isar. 10 past 9. Could learn a few things there, Ronnie. And then Dumb and Dumber are on at 9:35 with Man versus Machine. What is going to be the latest? Are they beating ChatGPT?
I am actually itching to find out. I was struggling to sleep last night, and that's because I was so curious about what was going to happen in Man vs. Machine.
You should have just put it on. You would have got to sleep like that. Right, let's go into some overnight action, Ronnie.
Yes.
Aha, the Duke of H. I see you in the chat there. Good morning, sir. We welcome you. Good to have you back. Haven't seen you on the chat for a while. And also Funky Gibbon. Hope there is a sign for the markets. Well, not if you're short. Hello. What a beautiful move in Apple. Beautiful move. What a stock. Neil Brewster, good morning to you. We got two Neils on this morning. Neil number 2 telling us that Maersk is raising its outlook. Looks like a really good quarter for them, actually. And yeah, we got a few things to go through, don't we?
Yeah, let's see what we got up. Why don't you do us all the favor and pull up the overnight news from your paid Financial Times subscription?
Yes, he's only gone and done it. He's only gone and blown the doors off. Producer Phil has come through with the goods, and this is our new and improved Financial Times subscription. Although I don't think I've logged in yet. Right, here goes. So, Donald Trump threatens 100% tariff on chips, but they've managed to cook up a deal. And Apple rocketing higher yesterday, 5% in normal hours, and then another 3% after hours, as he did the high fives with Trump. However, the story comes out this morning, Trump made it up as he was going along.
That sounds very unlike him, to make information up.
So his commerce department had no idea what he was about to offer Cook. And Donald Trump and Tim Cook in the background had a discussion on what the deal was going to be. They came out into the press conference and Trump made up something else. It is an absolute farce what is going on in that building just now.
I mean, Tim Apple, I think he's done a good job in identifying the fact that the Trump administration is a pay-to-play administration. It's very simple to just, if you throw in some figures in and say that you're going to invest a couple $100 billion, you're going to be treated like royalty, and you're going to be carved out of tariffs, which they're going to be now. Nothing to see here. Just move along, people.
So let's take a look at the 5-day chart of Apple here.
Look at those P&Ls, baby.
So this is when Apple came out with numbers, right? Numbers were fine. They were agreeable to the market. Then we had the big sell-off. Look at that, all the way down to 202.
You really caught that dip nicely, mate.
What, that one? And then story comes out yesterday about 20 past 1 that Apple was investing $100 billion additional
to the half a
the
trillion they already have committed to investing.
And it's not even that they're not building factories or anything like that. They're doing deals with the likes of TSMC, Broadcom, Supermicro. And so the market started to go, and the White House announced that Tim Cook was coming in. So that was part of the excitement. And then last night at 10:30, it went again.
My question for you, Rich, is as Trump initially came out with the tariffs, mainly designated towards the Chinese, the response from Apple was to sort of start moving production, especially for the iPhone production, move it towards India.
Yeah.
Now India has been hit with a 50% tariff due to their oil purchases from Russia. So how do you see Apple sort of circumventing these tariffs and having actually a cost-efficient production?
It doesn't matter. He's done a high five with Trump.
Okay, sorry, my bad.
Don't you see that? Pay for play. As long as you get in there and you throw out a huge number, like the EU have finally cottoned onto it. We're gonna invest 600 billion into the US.
Yeah, with no actual concrete figures or plan or anything to have invested.
And then Trump has asked, well, what's the 600 billion going to be invested in? Whatever I choose, whatever I tell them to invest it in, genuinely is what, like, you'd think it was artificial intelligence that was putting these videos out.
I mean, Jimmy Carter sold his peanut farm when he became president. Donald Trump launched a meme coin. Yeah, I mean, it's laughable at this point, but
markets are moving on it.
Twisted vine, thy wicks to stretch like fate's design.
Is there something wrong with the system? Are we on the waiting list to tech support? What is going on there, guys?
Producer Phil.
Right. Okay. We don't know what that was, but it seems that the technical issues are still ongoing.
Some fat finger errors, not only on the trading desk.
So we've had a look now at the front of the Financial Times. Let's go to the Times itself. A little bit more UK focused. UK house building falls at its fastest pace since the onset of the pandemic, Ronnie.
I would say that I'm surprised, but I'm rather not. I mean, the new Labour government has pushed a lot on sort of building in infrastructure, has been their ways forward to stimulate the economy, and they're going to achieve this by cutting red tape and etc., etc. But nothing has been done. No red tape has been cut. No sort of incentives have been given. So I can't say that I'm surprised that it's falling when we have rates so high, and there's no sort of incentive from the government for the builders and to build affordable housing more than anything, but nothing's really happening.
Not for much longer, because what's going to happen at 12 o'clock today, sir?
Our beloved Ted Boley will cut rates.
That's right. We are going to see a 25 basis point cut today at 12 noon. And that is going to be the 5th time in a year. And it says here the forecast is to vote 5-4 in favor of a quarter point cut. However, that is misleading, because what in fact is happening is that you've got 5 people voting for the cut of 25 basis points, and you've got 2 voting for a cut of 50 basis points.
But
so it's actually 7-2. So it's a it's a done deal.
I wouldn't say. I mean, absolutely yes. There needs to be a rate cut in the UK. We've been higher for longer, for far too long. However, the issue persists in the fact that we have a higher inflation in the UK. The inflation remains relatively strong. the inflation remains relatively strong, and then
3.6%.
3.6%, and in addition to this, we have a weak growth. So this is the horrendous, sort of ingredients for a horrible cocktail. So I'm not really excited about the macroeconomic landscape. If you look at, for example, across the pond in the US, it's much more, sort of convincing that they need maybe a 50 basis points cuts because they have strong figures, strong labor figures. However, they're seeing some sort of slowdown, and that could be counteracted with a base rate cut. But in the UK, the situation is much, much trickier, and I think our beloved Mr. Bowley will have a tougher time ahead than Jerome Powell. At least his job is safer than Jerome Powell's.
So how are you playing it in the demo account then? Let's have a look at the cable there. We're at 133.74 at the moment. It sounds like you're particularly bearish on the country. Is that including the currency?
I would say so.
So you're short cable in the demo account?
Personally, as a proud, soon-to-be British citizen, I would never go against it and short the currency.
Wait a minute, sorry, have you got engaged?
No.
You're going to marry her to get the British citizenship?
No, she's not a citizenship. I mean, a citizen. I'd love to marry her, but it's not for the citizenship. I'm gonna apply for it this year.
Great. So you're going to apply for that, but you can't even be bothered to put a short cable on your demo account.
I mean, it's counterintuitive. The heart says no. The mind says yes, but the heart says no. Right?
But all your savings are in GBP, right?
True.
So then you're already long hedge. GBP.
That's true. Fuck it. I'm doing it. Sorry for the F-bomb.
Oh dear, we are sorry for that. Especially to the Duke. Oh, the Duke is watching us this morning, sir. You cannot be throwing out language like that.
My apologies, good sir.
Right, we've got the GBP 133.75. What's it going to be by the end of the day when we get 25 bips cut? And in the language, that's the important one. Are they going to continue to talk about slow and gradual cuts from here on in? Are we going into the threes against interest rates in the US? That who knows? Who knows?
I don't think this year. Definitely not. I do think we're going to see, I've been a big, my view has been so far that we're not going to see any rate cuts in the US this year. But after the latest economic data figures that were released, I've quite drastically changed my opinion. I think we're going to see two, minimum two. If I'm stretching it, three, but most likely two. But I think this year we're going to come down to the threes, high threes.
Okay.
I don't think we're going to come down to a 2% level by next year either. No, by 2026. Do you believe that we can come down to a 2% level by next year?
Of course not.
Good.
No chance.
Good.
There's going to be serious issues in the economy if that happened. And the stock market would be down 40%.
Duke of My Grace accepts my gracious apology. Happy to hear that.
Thank you, sir. Right, I am going to sell £2 a point of cable, 133.74, because we're long cable, naturally. Your big salary check that's about to dump into your account.
Massive.
It's about right. I'll sell your salary for the month in cable.
£2.
Put it into dollars there. Right, what else have we got in the Times today? Let's have a look at. He's quick on the getting the thing up there, isn't he? We've covered Apple. We have covered interest rates. Let's go to the US numbers yesterday. So we had McDonald's reporting numbers yesterday before the market. The stock did enjoy it. The stock went for a happy meal yesterday with earnings per share of $3.19 adjusted versus $3.15 expected, and revenues 6.84 versus 6.7 billion expected. So 3% beat there. And just generally it was reassuring for McDonald's investors, wasn't it?
Absolutely. And I think the sort of concern going into the year so far has been discretionary spending from the consumer. That's where we've been worried, looking at the prices, seeing, will consumers sort of hold back? Companies such as McDonald's will be the ones taking a hit.
Chart off, guys.
However, one, they put their focus on the sort of value meals, which is something that's clearly paid off. But something that further, expands on this is that we saw that DoorDash in the US also had a strong results.
Well, let's just take a really quick look at McDonald's. It has been so stagnant there around that $300 mark. I mean, if you want a defensive, this is the one, right? It trades at $300 and it goes down to $2.90, it goes back to $3, goes up to $3.10, back to $3.
Yeah, a lot of excitement going on in that stock, especially for someone like you, Rich. I mean, you're a big Vodafone guy, so maybe this is the American Vodafone for you.
30% year to date.
No, I do think McDonald's is a good stock, and I think they've done a good job in sort of rebranding and adapting to the market conditions that they're faced with. We see in the US that sort of fast food chains or like fast casual restaurants are going under by the minute. So I think they've done a really good job, especially if you compare it to the ones of Starbucks, who have been struggling, and other chains. And for example, our production room, who are unable to realize which buttons they should press.
So yeah, you were going to go on to the dash of the doors.
The dash of the door, DoorDash, which sort of goes into the same sort of discretionary spending, sort of delivery of food. For those of you who don't know, what's interesting about DoorDash is that their main difference to Uber Eats is that their focus has been to go on the sort of rural areas rather than the urban areas. And they've done significantly much better and taken a lot more market share than Uber Eats. And it goes hand in hand with the McDonald's results, seeing that the consumers, they still have, I mean, obviously they have reduced purchasing power. However, they're just more selective with it. Mm-hmm. So they look for more value, and you get better value for your money via McDonald's value meal, via a DoorDash in the rural areas rather than the metropolitan areas. So the consumer, the American consumer that is still strong and is still spending. They're just more selective with where they allocate their capital.
And it doesn't look like it is Disney. So Disney numbers yesterday down on the day. We had earnings per share of 161 versus 147 expected, but the revenues were a miss. 23.65 versus 23.73. Net income for the quarter was $5.25 billion. But it just wasn't really enough. There wasn't enough there to warrant the performance in the stock.
No, but I am still quite bullish on the outlook of Disney, much due to they announced the full Hulu integration to Disney Plus, and they also the partnership with NFL. So they will now stream all NFL games on Disney Plus. So that is something that's major for the American consumer to sort of lure them over. And Disney Plus has been a big source of growth for Disney.
Yeah, so if it was between wrestling on Netflix and NFL on Disney, I would definitely choose Disney, yes.
Really? I thought you were more of a sweaty, half-naked guys hugging each other type of guy.
Wow. Right, let's have a look at the what it did during the day then. We saw the stock 122, boom, down to 115. So it was a move higher initially, and then it settled around the 115 level. So yeah, Disney not the performer yesterday. I don't know, McDonald's, Disney, Uber. Let's have a look at
you probably got really excited about Uber after their 20 billion buyback.
No, I only go for buybacks that are a significant part of their market cap, like Vodafone, that take the stock higher every day.
Because the company itself can't produce results that will move the stock price up, so you've got to reduce the stocks in circulation.
Just wait until they do. Another 30%. There we go. So Uber, very dull. Very dull indeed. Stock trading back to where it was the day before at $89.
Rich, 20 billion stock buyback. I mean, we've obviously talked a lot about an Expedia acquisition / merger. Do you think that, how do you think the sort of stock buyback comes into play in relation to that? Is this something that they're doing instead of the Expedia acquisition, or is it something they're doing in order to sort of pile up on shares so they can do a all stock merger?
That's fair point, yeah.
What's your opinions? Or thoughts, perhaps?
Yeah, I guess it would make sense to have a lot of the deal as a stock for stock if they were to buy it. But it has gone quiet. We haven't heard anything more on this Expedia deal.
What's not quiet is my man David in the comments. Big shout out to him. Very nice guy.
David, I didn't know that's what your mum's login name was on YouTube.
You and I will have a chat after the...
Boise said not all Davids agree, apparently.
Not all Davids... Oh, Boise, come on, man.
Right, it is time for Guess the Chart. What is the chart going to be today? But also, what genre is the music going to be? We've got a little double game going on. It's a UK stock, everybody. Let's see your guesses in the chat as you're giving us the big thumbs up to get rid of Ronnie. If you want Ronnie gone by 8:05, give us a thumbs up in the chat.
Please.
We'll see you in 2.
It's green, it's red, it's looking tight. A breakout move or fake out flight. 2-week dip or pump in stealth. Guess the asset, guess the wealth. Head and shoulders, double top. Diamond hands, or should I stop? FOMO buys or capitulation. Guess it right, earn your station. Fibs and zones, they try to fake. Is it Tesla? Is it cake? Zoom in tight, you've got the heart. Now light it up and guess that chart. Guess the chart, win or lose. Rug pull trick or daily news. Read the rhythm, play your part. One last call, guess the chart. Producer Phil's got tricks up sleeve. He'll throw a curve and watch you leave. Rich is cool, but don't be fooled. He's seen more charts than you've been schooled. And Angel mate, she's sharp as steel. Guess it wrong, she'll close the deal. Guess the chart. Guess the chart. Guess the chart. Guess the chart.
What are you laughing for?
Oh dear. Shall we do a poll on who likes the new music? Come on. What's been your favourite music of the last few days? Was it day 1, day 2, day 3, or like it used to be with the probably the most annoying jingle of all time?
Just a note to the people working at IG. If you're disappointed with your bonus, it's because all the money went to producing these songs.
It cost £10.
£10.
Yeah. It's quite impressive, actually.
Hey. You get what you pay for, eh?
Right, okay, the most important thing is, did anybody get it? Because I certainly didn't. Was it Funky Gibbon? Well done, Funky Gibbon. Now that, I tell you what, Aviva That's a nice steady performer. It's a bit of a crap chart that they've shown on there. Let's get a proper one up. So let's see a decent one of this on the daily, because it's a stock I haven't looked at for a long time. And there we go. It has been a performer, hasn't it?
It's nothing you'd expect of, you know, such a old school.
Yeah, exactly.
Financial giant.
Yeah, Legal in General, Aviva. But there you go. I think that underlines the performance of the FTSE this year. That stocks that have done nothing for 2 years suddenly have gone from 450 to 650. The power of the UK, my friend.
Fill up your ISAs at IG Invest.
Brilliant. Is that today's?
No, don't think so.
Shame. Right, okay, we are 7:59 and 15 seconds. Let's get your opening calls. There's not, yeah, IHG had numbers. They were all right. Nothing particularly special. The stock is looking unchanged. BP has been raised to buy from hold at Berenberg. I've got these in my sights. I want to buy BP and I'm going to talk about it every day. Marks and Spencer's down 1%. That's been cut to reduce at Alpha Value or Badder. And WPP up 1% on the back of H1 results. Also, we've got a huge amount of ex-dividends today. So a lot of the moves are going to be distorted by the ex-dividends. Ronnie, ring your bell. There we go. Right, ex-dividends this morning. So ignore stock moves in AstraZeneca, Barclays, BT Group, Informa, NatWest, Relics, Reckitt Benckiser, Rolls-Royce, you're getting 4.5 pennies there, Standard Chartered and St James's Place. The biggest dividend payment day of the year, cha-ching. If you are a long holder, you'll see most of those stocks are detailed there. So is there anything there that's not ex-dividend? No, I don't think so. So let's look at the moves higher. Ronnie, take us through what's on that page.
Right, we got Flutter Entertainment, the good old gambling company, moving upwards. Wizz Air probably got some revival for once after taking such a beating. Whitbread, don't be fooled, it's not a bread company. Entain PLC, also gambling industry, going strong today. HSBC have been going on an absolute tear lately. I'm quite impressed with the turnaround that they produced and the sort of restructuring of their costs. So they've done an excellent job there and the market is rewarding them for that discipline. Associated British Foods, Rich hasn't done a lot of Primark shopping lately, so they're not moving. What else do we have? Diageo. Is that how you pronounce it?
Getting back to £20. That was from £18.15 before numbers. So a nice 10% move in Diageo since those numbers.
And mine and my hero Luke Moore's favorite company, Scottish Mortgage Investment Trust, coming up there, slowly clawing back.
It is. It's been very steady, hasn't it?
It has indeed.
Okay, but on the downside, we did see some big movers there. WPP down 3% on numbers.
It's almost like someone has been banging on about how the business is not future-proof. Yes, what else do we have?
What were they? Were they £4.60 when we were talking about this?
I think they've gone, oh, look at that.
I mean, this is in real trouble, isn't it? The profit warning was £4.50, £4.40 on that day. But let's look at what's happened since there. That is a shocking price action.
Yeah.
And yet again today, down 3.5%. So WPP is one of those knives that it's just got blades at both ends, doesn't it?
It doesn't, yeah. You don't want to catch that falling piano.
Falling piano. Right, of the dividends you see there, BT's dividend, NatWest is dividend, Reckitt's is dividend, Vodafone is not. So Vodafone, that is a clean down 1.3%, 84 pence. That must have had a strong day yesterday. Glencore, shocker of a day yesterday.
Yeah, well, they've now agreed to keep their listing in London and not move to New York, which I believe is positive news for the market overall. But Glencore, we were talking about Glencore for quite some time at a much higher price level, and so they're looking attractive.
£3.15 they were, well, no, sub 3 they always look attractive.
Yeah, well, in
Just the general view.
in the words of Pete Ward, if you like them up there, you'll love them down here.
Perfect. Right, let's have a look in Europe. Rheinmetall had numbers, as did Siemens. Siemens down 27 basis points. They said that they would confirm full-year guidance with Q2 orders up 28%, but the stock very bored
And
there.
in addition to this, they have a 136 billion euro backlog driven by data centers' electricity demands. So this is, if you're looking for picks and shovels of the AI revolution, Siemens Energy is a company that's really gonna sort of pull that across.
Well, no, that's two different companies, though.
Well, Siemens Energy, I'm talking about Siemens Energy. You're talking about Siemens. I'm talking about Siemens Energy.
I'm just talking about the one that reported numbers this morning.
Well, I'm talking about the one that actually did something interesting.
Rheinmetall is certainly interesting. That's down 5.6% this morning. That's on the back of their numbers. So defense sales up 33%. But, you know, let's not forget the stock's probably up, what, 100? So
Yeah, it's absolutely roofed. So 5% is nothing but a blip.
yeah. And then Adidas, new lows on Adidas. Since we told you 2 months ago that the fashion is done. Everybody's got their shoes from the 1970s and no more. So huge profit warning there. Stock dropping from 210 now down to 162.
I can't believe the people didn't take fashion advice from you, Rich. It's shocking.
We've got matching shirts on apparently today.
We're not the same. Moving on.
Oh, yeah, so that's it. Let's take a look at commodity world, shall we?
Shall we have a look at the winners in Europe?
Yeah, let's have a look at the winners in Europe.
So
You
kind.
got one in your mind there?
I was just curious to see what's going on there.
Oh, thank you very much. That's helped me a lot, actually. I'm long ASML from 640 and then 620 and then again at 600. But they were looking shocking yesterday. They're down at 591.
Listen, if you love your grandchildren, buy ASML. Is what I've been told by my equity research friends. Which is not financial advice, just what I've been told, and I'm repeating it.
Lufthansa up 1.3, Ryanair, so strong day for the airlines, and
Bit of a cheeky clawback from LVMH, 1% up. Interesting to see how they can sort of maneuver in this new sort of consumer economy where the focus is rather value rather than luxury and quality. But yeah, interesting. The banks are especially the European banks, along with the American banks, they're all continuously to do well.
I'm dying to see the poll results of the music. If you haven't voted for the music, then please vote now on your chat. Also, give us a like, give us a follow. And it is now 7 minutes past. Angelina is going to be in here soon. But reminder for those that weren't here at the start of the show, we have the Smarter Web Company in today. The CEO joining me at 8:25. Before that, at 8:20, for all of you like Ronnie that still do not understand the business model, I am going to do a quick 5-minute explanation in a way that I haven't explained it before.
Can you send me a recording so I can keep it to battle my insomnia later on?
When you'll be able to sleep tonight, buddy. Don't you worry. That Red Bull will have worn off by then. So yeah, Smarter Web Company. Join me at 8:20 a.m. in 12 minutes time, and I am going to explain the business model of this company. Why has this company gone from being worth 150 million to 600 million in a matter of weeks? Then at 8:25, you're going to hear directly from the CEO. Stock up 3% this morning in anticipation.
Yeah.
Right, Ronnie, I'm going to leave you to Ange now, seeing as you're out of out of words, and Angeline, I am going to let her break the poll results. We'll see you very shortly.
I'll miss you, Rich.
If you're looking for flexible ways to trade financial markets, whether you're experienced or new to trading, you've come to the right place. CFDs let you speculate on the price of financial instruments like shares, indices, forex, and commodities without actually owning them. You can benefit from both rising and falling prices across 17,000 markets, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going to go down, you sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions with less money up front. So this increases your profits on your trades, but also remember your losses are also amplified. So be sure to manage your risk. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade CFDs with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Bring me the next shiny new thing. Bring me the next shiny new thing.
Hey, trader friends, welcome back to the show. Good morning, Ronnie.
Morning, Ange.
Wonderful watching you from the outside. I did have a big laugh when you were teasing Rich about, the buybacks, and we know your feelings on buybacks. And
Yeah, I'm not a strong advocate for buybacks, unlike Rich. I actually believe companies should innovate and create value for their clients and shareholders.
invest in staff as well.
Exactly.
Good morning, Andrew McKilvey. We will make sure that Rich will ask the CEO about those warrants as well. Maturin Paul, good morning to you. Sogjin, we will discuss that in a moment. Thanks for the heads up. And Funky Gibbon, yes. Those of you that hold Aviva, I do too. It is very much part of my UK stocks defensive play. And Maturin talking about Wizz Air as well this morning. But I was going to ask you about IHG. Do you ever use any of the IHG hotels? Holiday Inn, maybe?
IHG, I can't say that I do use them very much. Maybe, hopefully, one day if I keep working hard with Rich, maybe I'll afford a Four Seasons lunch or something like that. But they,
of course.
they had very good results. Pre-tax profit was 633 million, where the estimate was 516, and so they produced really strong results in a as we've talked about, sort of economic downturn where people are spending less. And I think that's where the value of the portfolio of intercontinental hotels comes in, because they have such a diverse portfolio of hotels. So everything from the Four Seasons to Holiday Inn. So regardless of your budget, they have something to offer. But another hospitality company, which I know you're a massive fan of, Ange, Airbnb, they also reported very strong results. How do you feel about that? Something you want to tell the people?
He's doing this on purpose. He knows I really dislike the Airbnb model because I just think it needs a lot more regulation so it doesn't change our suburbs into, hotels and ghost towns. But speaking of which, Airbnb is another one that we are watching for you because Airbnb will be one that I think will move quite rapidly. It is all sessions here on the IG platform, but we are seeing indications of that stock moving lower on very thin trade. Now, the thing with Airbnb, what the Ange likes is that the company is saying it sees slower growth.
Which you like.
Now, I think Airbnb, if you look at the share price here, I think it could potentially go down further. It has broken past lows seen since the 30th of May, broken down past that, which means that its next area of interest is around that 116 mark, which was last seen early May.
Well, unlike you, Ange, I'm a big fan of the Airbnb business model because
Because Ronnie's ruining people's homes and where they live and areas.
You can check my reviews, only 5-star reviews. I think Airbnb has an incredible business model because without having the capital intensity as an intercontinental hotel group has, they're able to scale rapidly across the globe and keep relatively healthy margins. So we saw that the Q2 results, revenue was up 13% to 3.1 billion and adjusted EBITDA margin at 34%. Net income of 642 million. And they're even guiding for 8 to 10% growth for the next quarter. So I think it's something that it's a company that's really, profitable in the sense that they can scale rapidly and do so without the capital intensity as a traditional hotel business has. And they're doing so while being profitable.
Is this Ronnie's heart talking or is it Ronnie's portfolio?
Both.
Airbnb just telling you here, they forecast third quarter sales which beat estimates, but yet the share price is indicated down sharply.
It seems like they've listened too much to you, Ange.
The thing about Airbnb is that I think the company's grown a bit too fast, too quickly. It's also right now seeing that we are seeing a bit of this fatigue after the travel madness after COVID, right? Don't forget the United Airlines, the American Airlines, all those big names to do with travel. TUI as well. They soared after the last lockdown was lifted. Trader friends, if you are one of those that took advantage of this and just went travel mad after the lockdowns, let us know. I'm looking at Ronnie here because you look like one of those people that paid like £20 a bottle of wine when the bottle of wine was only like £7.
Well, I am not a drinker, so I'm more of a
Coca-Cola.
Yeah.
Kind of man.
If I get a bit freaky, I go for a Diet Coke. Otherwise, I'm a lime soda type of guy.
Wow.
So I'm short Diageo.
Really, crazy parties at your house.
Oh yeah.
Speaking of which, Airbnb, we are watching that one. Some of the other ones that could be in view as well, just coming off my chart there. Maersk rising on the outlook. We'll take a look at Maersk in a moment. Also, Henkel. I don't know whether any of you trade Henkel because this is the best least known stock ever.
Well,
lots of people don't know Henkel, and it is up.
I'm one of them, so please do brief me.
You are a consumer of Henkel. Trader friends, if any of you own a smartphone, you are a consumer of Henkel. They make adhesives, manufacturing grade adhesives that are in everything from your laptops that are in front of you that you use every day to your iPhones to aircraft because the adhesives are so strong. It means that you don't need things like rivets, right? Heavy metals. And Henkel is in almost every industry. And right now, Henkel is up because it cut its full-year sales guidance, but says that it's going to see higher profits because of these cost savings. So they do everything from products that are used in beauty to laundry to home care brands, but they also, of course, do this very interesting adhesive business. Rheinmetall. Have you talked about Rheinmetall already?
Just a blip of Rheinmetall. They took a little beating. They're down about 5%, but feels like the stock is up about 10,000%
Yes.
lately.
Yes. So I think it's not going to be frowned upon, that little blip lower there, given how far and how fast it has risen. Sachs, you still holding Rheinmetall? I still have exposure to Rheinmetall there. I just think this is a tiny blip because of the spending by the Europeans that have been earmarked. That still has to be deployed.
Well, they did increase the defense spending, and something that we're going to see. My question now is, I think people are wondering, are the future spending already priced into this stock, or is it something that we're going to keep seeing as a catalyst for further rise of the stock? But more likely than not, in my opinion, I think the pricing already includes the future 5% NATO spending. But I also don't want to be the guy who says that Rheinmetall is overvalued and it's going to keep rallying, and then we're going to see it go up another 50%.
You and many other fund managers.
Exactly.
Are now saying, before they would never talk about Rheinmetall, they'd never talk about defense. Now they call it tactical deterrence.
Tactical
We're
deterrence.
invested in tactical deterrence. Speaking of tactical deterrence, another mover is Merck. Let's have a look. Merck is currently down and going lower, down 2.2%, but now down almost 3% there. Just having a quick look at Merck there. This is after it raised its Forex adjusted profit guidance on its drugs and lab gear. But before we go, we've got the poll results.
Breaking news. Producer Phil in my ear.
Producer Phil, breaking news. Here we go. Read it out for us, Roddy.
All right. So, do we like the new Guess the Chart music? Love it. Loving it, keeping them coming. That's 80%, whereas 75% of those are Phil's burner accounts. Try something else. It says 14%, and whereas 13% of that is Rich's burner accounts.
Burner account.
Bit hit and miss. 3% prefer the old music. 1%.
Who is the 1%?
That was.
Mr. Anderson.
I can't answer that.
Right, we gotta go because Mr. Anderson's saying hard rap now. Right, Twitter friends, we'll be back. Don't go away because SWC is up next.
Okay guys, before I teach you how to use this, I have to teach you how to use this, the mind. The cash return wasn't all about speed, it wasn't always about power, it was about the mind. Become the bull. Visualize greatness. Okay, minds are ready, time to go. Hey, come on Pat, come on. Cash returns, come on. Oi! Oh, you're not going to get better than cash returns.
Today we're here because we've recently launched our Save Our Stock Market campaign. We just want to raise awareness for terrible cash returns that everyone is getting with their money just sat in cash ISAs. What we want to do is raise awareness for the great returns that you can get on UK stocks and help revive the UK stock market and get people investing.
There's a lot of bad feeling about the UK stock market, and it's really negating people's view on the UK market as a whole. There's some great companies. If we just start the ball rolling on people getting behind the UK stock market, then we can start to get the interest, and it's days like this. We get awareness of all the crowds talking about stocks. It's really that awareness, and ideally we'd like to take it to the government. We would like cash ISAs to be reduced, not because we don't believe in the chance of people saving, but more that you get higher returns, as much as 7 times historically, in investing, that you can from cash. And that's not saying people go out and take a load of risk. It's about education, and it's about helping people to understand the benefits of investing and the limitations of holding their money in cash. Right, welcome back everybody. Ahead of having the CEO of Smarter Web Company on, I wanted to really break it down on explaining the model of Bitcoin treasury companies, right? This isn't just Smarter Web. This is, whether it's MicroStrategy, whether it's MetaPlanet, to be able to get your head around this, it's really tricky, right? It took me about 3 months to actually understand how this thing works. Because if I'm going to invest £10,000, why wouldn't I just put £10,000 in Bitcoin? Why do I need to buy a company, a vehicle? Well, in the UK, yes, you can buy it in your SIP, you can buy it in your ISA. So that's one reason. But that doesn't get to the heart of the model, right? So forget Bitcoin for a minute. Let's explain this in simple apples. Right? Now, if I've got the money I want to invest, I can buy 3 apples. It's as simple as that, right? That is like putting your £10,000 into Bitcoin, because people can call it a Ponzi, they can call it a pyramid scheme, right? But to really understand this model, all you need to know is that, yes, I can buy 3 apples today, the same as I can invest £10,000 in Bitcoin, or I can invest in an apple tree. And if I invest in the apple tree, it's only got 1 apple, right? But I'm investing in a tree that produces more apples every time somebody else invests in it. Every time somebody waters the tree, a new branch grows and you get more apples over time. Forever more. As long as it trades at a premium to its MNAV, then you have more apples grow on the tree, and over time, then you'll end up having 5 apples, 6 apples, 7 apples, 8 apples. Your original apples that you bought, the 3 of them, if you don't invest in the tree, if you just invest in Bitcoin, those can go up in value over time as Bitcoin goes up in value. That's fine. But you'll never have more. You'll only ever have 3 apples. If you invest in an apple tree, then over time you can grow more and more and more every time that the tree is watered, every time Andrew does a capital raising, an equity raising, or now issues these smarter convertible bonds. And that is what we are going to speak to him about today. So it's really getting your head round the chance to compound your Bitcoin over time. And that means compounding your holdings of Bitcoin, not the amount, right? We all know the value of Bitcoin can go up, but you can take part in the chance of the value of Bitcoin going up at the same time as your holdings of Bitcoin increase. So, without further ado, we will be back in 30 seconds with the CEO of the man who brought this Bitcoin treasury model to the UK.
Hello, I'm Axel Rudolph, Senior Technical Analyst at IG and Fellow of the Society of Technical Analysts with over 30 years experience in trading the financial markets. I've been following cryptocurrencies from the very beginning, and with IG's new crypto offering, I can finally share my technical analysis expertise on crypto with you. So join me every Wednesday morning for my new show, Charting Crypto, where I'll be answering your technical analysis questions on all things crypto, live on Trade Live with IG.
Well, I am very happy to invite back Andrew Webley, the CEO of Smarter Web Company. How are you doing, Andrew?
I'm good, thanks. How are you?
It's been, I think, 2 months since you came into the studio. Longest 2 months of your life?
Certainly some of the best 2 months of my life. Yeah, it seems like a lifetime ago that I came into your studio. Yeah, a real lifetime ago.
That's right. And the stock was at 28 pence. I think, did you own 30 Bitcoin or 50 Bitcoin, something along those lines? Give us the total now, the official release total of how many Bitcoin you now own.
So we own 2,050 Bitcoin, but everyone can see from the public filings that we've released that we've got enough cash for over 2,300 Bitcoin. So that's a fair multiple from when I saw you, which was only 2 months ago.
That's right. And we've seen a lot of volatility in the stock. It's gone from 28 pence when you were on up to as high as, did it touch £6 at one point?
Yeah, intraday.
Yeah, so the volatility has just been incredible. When some of our viewers have had the enjoyment of participating, I know one of them has managed to buy a car off the back of it, and I guess we spoke yesterday, and I invited you back on. You said, "Yeah, great, no problem. I can come on the 18th of August," and I said, "No, Andrew, please." Even if we can do a live link from home, we need to talk about this the new move into these bonds, because it's not just a convertible bond, is it? It's a smarter convertible bond.
Yeah. So when we listed the business and we IPO'd it, we did effectively private placements. So from the start up until now and into the future, we can raise capital through equity raising, private placements, whether that's from retail investors, high net worth investors, or institutions placements. And then what we did is we devised a way that we could do something that's very common in the States, which is an ATM style facility, so that in the background, every single day, providing it's an up day, we can effectively sell our own shares through an intermediary, and we can raise capital that way. And then the third thing that we announced yesterday is what we've called Smarter Convert, which is the third strategy that we've got, which we believe is an excellent way to generate additional capital for the business. And in my opinion, with zero downside for the business, funnily enough, zero downside for the investors as well. And that's a third way that we can generate capital for the business to fulfill our business strategy.
That was, and the way I like to think of it is pools of liquidity. And originally, you were just swimming in this pool of liquidity of equity raisings. And the ATM, like you say, just gives that, a nice little announcement every couple of weeks now that updates people on, you almost don't notice it. Because it's like a reverse buyback, is how I think of it. And then, this third one yesterday, if we're going to stick with the Apple's theme, because Bitcoin does make it a little bit more complicated in people's minds. But the worst case scenario is people have given you £21, you instantaneously go and buy a load of apples, and the very worst thing that can happen to the company is you have to give the apples back.
Well, yeah, but we keep 2% of the apples as well. So from the investor's point of view, they're sort of risking 2% of their apples in order to make a greater return. And from the business's point of view, we're hoping that the apples convert into equity, and then they become our apples. And it's a beneficial way of raising equity. So as an example, because the premium that they pay, the conversion price they pay, is only 5% above the market price at the time, it's better to the tune of 5% for my shareholders that I can do it in that way if it converts. So and there's no interest or anything like that on it. It's 0% interest from a really, really credible investor. And that was the other thing that everyone started to understand the Smarter Convert yesterday. And I think over the next few days, they'll understand it and they'll see it how I see it.
Yeah.
But the really cool moment also yesterday was it was our first, public name that's become an institutional investor. Obviously, we've got institutional investors, but this is the first capital raising that we've done where we've been able to name the institutional investor, and they're really good people, so that's great.
And so, can we talk about how this came about? Did they come to you with the idea, or I know that you've been working on it for weeks. Is it did you start off with a seed and then you kind of negotiated on how it should look, or was it simple to come up with?
Yeah, so I think about everything all the time in terms of ways that we can generate capital and all of the other aspects of the business, because in some ways it's very simple, in some way there's a lot to do, so we think about all these things, and we've got lots of ideas of different things we'll do in the future. Now, I met with Michael Saylor from Strategy a couple of weeks ago in London, and we had a good chat about what we should be doing longer term, but clearly his business is way bigger than ours at the moment.
So far.
Yeah, so far. So one thing that I'm slightly worried about is exposing the business to any debt. So I'm quite cautious. I love Bitcoin. I've been investing in it for almost 10 years. I believe it's the best asset in the world. But my job as the CEO of the company that I set up 15 years ago, we listed this year, is to see that the company is very, very successful for the medium to long term. So in the short term, we do have to be careful about debt. So we've had this idea, and we've had loads of people suggest different things to us over the last couple of months. And, some of those things are good, some of them not so good. Yeah. So the thing that I couldn't get my head around until very, very recently, let's say a week ago, is exactly how I could do this thing so that I was 100% happy to do it, because I don't want to do it if there's any doubt, that's not good enough. So that's why the terms are in some ways very, very simple, in my opinion, very, very clean, but also beneficial for everyone involved, in my opinion. So it's just getting the terms right, Yeah. So in any relationship, you have to make sure that the thing that you're doing together works for everyone. Otherwise, it won't work for the long term. It's as simple as that. So what I didn't want is I didn't want a deal that was, lopsided for the investor or for the company, because it's not going to work for the long term. And we want to sell a lot of this particular instrument. Right. So it just took a bit of time to get it right. And I'm really pleased with it. There's a couple of small tweaks that we might make for future rounds. Okay. Maybe we'll increase the premium that they have to pay. Maybe we'll extend the duration from 12 months to 24 months. We want it to be quite short term.
Yeah, that was the thing that kind of struck out to me, was 12 months is relatively short in the life of a bond. So, that definitely, had it been 24 months, I would feel a little bit more comfortable even. I like it as a shareholder. But yeah, 24 months it just seems like a decision has to be made relatively soon, because we know how time flies, don't we?
Yeah, well, that's why it's priced as it's priced. So their conversion price is very, very close to the current market price. Yeah. When it gets into the second half of the instrument, so the second 6 months, I've got the right to force them to convert it if it's 50% above that. If you look at the last month or two, you can see, providing you believe in Bitcoin and you believe in what we're doing as a company, you can see how we'll quite comfortably get past that level. So that's why the 12 months is, sort of absolutely fine in my mind. Yeah. And then you've also got to think about the fact that worst case scenario, and I put this in the announcement as well, because I wanted to put it in simple terms, worst case, best case scenarios. Worst case scenario, we give the Bitcoin back. Yeah. And importantly, the $21 million that we've had come into the company, if Bitcoin falls in value, we give back the $21 million of Bitcoin that we bought with it. So we're not exposed to the volatility. In the short term, in 1 year, I don't think that you would necessarily want to structure it like that if it was based on fiat. But of course, if it was based on fiat, there would be other complications there. For example, there might be a small premium that you have to pay on the interest, and things like that. So, I genuinely believe that it's a fantastic thing for the company. And I think there's going to be a lot of interest from other people. But like everything else that we'll probably sell a lot of it, but we'll also sell it alongside our other activities and cap it to approximately 30%. But if you go back to those three things that we've used, the placements, the ATM, now Smarter Convert, any investor needs to step back and look at the three of them together. So they all work together to make the company bigger, again, in my opinion.
Exactly. It's almost like people who are scared about paying an MNAV premium, their thought process is, right, why don't I just take the money and invest in Bitcoin? Well, this is basically doing that. This is giving them the chance to buy a convertible bond, which is basically buying Bitcoin minus 2%, with an upside call option on the Smarter Web company.
Yeah, 100%. And, obviously we've spoken to other people that are interested in this particular product already. In the short time, i.e. 24 hours since the RNS came out, we've had people get in touch with us also expressing an interest as well.
Okay.
So there's a lot of people, there's a lot of institutions out there that believe in Bitcoin like I do. And there's a lot of people out there that have got a lot of Bitcoin. And we always say, what is better than Bitcoin? Well, the only thing in our opinion that's better than Bitcoin is compound Bitcoin, which effectively we're giving people some exposure to something like that. Yeah. I think it's a great solution for everyone, the shareholders, the new investors, and the company.
So let's take a look at the website, this great Treasury analytics page that you put together. So Bitcoin hold, we see there 2050. We see the NAV now up above 200 million sterling, which is huge. Now, does that include the 21 million? And it includes the 8 million that you raised the other day, but it does not include any updated ATM amount.
No, so that's almost right. So the figures on our dashboard, if you zoom up to the top where it says shares in issue and the market cap, we've put that in as a diluted figure. So what we did yesterday morning is for the shares in issue, we added in the shares that would potentially be issued if the Smarter converts, just to give people as much transparency and as realistic a figure as they should be using if they're looking at our company. So then if you look at the NAV, the 200 million approximately figure, and it's worth, saying when we're talking about our NAV of 200 million pounds, approximately, that we don't have any debt as a business, zero debt. If you're not counting Smarter Convert as a debt, because it's kind of debt, kind of isn't debt. So 200 million pounds there. And then the most exciting thing for me at the moment is if we look to the right of there and we look at the MNAV, you can see that if you believe in the Bitcoin treasury model, which I do, obviously, you can see that, based on the last few months, we look, quite compelling at that point. And you can compare that to things like Metaplanet, Strategy, Capital B, which was formerly called the Blockchain Group in Paris, all the Bitcoin treasury companies that I actually hold that I really like. Yeah. And you can see that it's pretty compelling at the moment if you believe in what we're doing.
That's right. So back to where you were on the 1st of May. So in terms of, if we wanted to think of this like a PE ratio, then the company has never been so cheap to invest in on a valuation basis from when it was first, from the 1st of May, which that is really interesting, and it also feels to me safer because the hype has gone. This craziness when we were up at double digits, even 15 times MNAV, that was it felt like almost like a meme stock, the way people were treating it at that stage. But now it feels, you've managed to bring it back. Chart off, thanks guys. You've managed to bring it back to this compelling, serious business that, as you say, you're finding new sources of liquidity. Because not only did you start with the equity offerings, you then listed in the US. And it's got the US listing, then the ATM, then this convert. Are there any other ones that, you know, are in the public domain that, you know, you can look forward to this new pool of liquidity potential?
Yeah, so we also managed to get in place a Frankfurt line of stock. So that's really important because we've got quite a big global base of investors, not just UK investors. You know, I live in the UK. We're a UK company, but we are as my daughter says, a global phenomenon, which she can say the word better than me, actually. And she's only 12. You know, so we do have the Frankfurt line of stock. We do have some other ideas of what we'll be doing in the not too distant future, but I can't really talk about that one. Going back to the point about the MNAV and the history and where we're at the moment, like this is just markets, as you know, Rich.
Yeah.
You know, when things are cheap, you know, less people buy. When things are expensive, more people buy. You know, that's what creates opportunities and things. You know, I've increased my holding in Metaplanet this week. I've increased my holding in the blockchain group last week, which is now called Capital B. You know, I fairly recently increased my holding in the Smarter Web company at approximately 100 times higher than when we listed the business.
Yeah.
I put in approximately £100,000 of my own cash into the company at that point. I think it's approximately the share price at the moment, maybe a bit higher. So, you know, it's just how it goes. You know, we're in August at the moment. We're busier than ever, but the market is quieter than it's been in our life as a public company because it's August. So you've got all these discrepancies. And all I can do as the CEO is I can keep doing what we're doing. You know, if we look at just this week alone, you know, we've announced a capital raise on Monday. We've announced Smarter Convert on Wednesday. Today is Thursday. And, you know, maybe there'll be other announcements before the week's out. We'll have to wait and see.
And this is just when you got back from holiday. I believe you actually managed to take a holiday amongst all this, Andrew.
Yeah, so I went on a holiday that I booked before we did the IPO. I had booked it. And then I started telling people where I was going. I went to Abu Dhabi, which was fantastic. And then my diary started getting fuller and fuller with people saying, oh, could you go and see this guy? Could you see this person? And it was great, you know, because I love what I do and I'm very lucky to do what I do.
Yeah. Fantastic. Well, Andy Smith giving the perfect example on our chat there, saying if you bought at 28 pence when Andrew was on the show last time, you now have 80 pence worth of Bitcoin. So, you know, this goes back to the tree idea that you're compounding this Bitcoin rather than only still having 28 pence of Bitcoin. And then other questions. That's a very fair question from R6 Senate as well. We've got to think about the risks on the downside as well. What do you think the effect will be if Bitcoin goes down?
Well, it depends how much it goes down by, right? So if it goes down a lot, which is not what I believe, then clearly our shares are going to take a hit because I don't believe in pounds. So I believe in Bitcoin. So we hold the assets in our business as Bitcoin rather than, you know, GBP or dollars or euros or anything. That's how I've run my life for almost 10 years. And that's how we run the business. So obviously, if Bitcoin absolutely bombs out, our shares are going to suffer. It's as simple as that. Now, over the long term, we're not going to sell the Bitcoin. You know, we're an operating business that's been profitable for 15 years. So I think the worst case scenario there is potentially it makes it harder to raise additional capital, you know, to keep the flywheel going.
Yeah.
But then at some point, if we look back at the last, you know, 16 years of Bitcoin, you know, historically, when it's had a correction, it's always then improved and it's gone considerably higher. You know, it's the best performing asset over that time period by far. I think there's only been, off the top of my head, 3 bad years in that time period. 3, you know, which is awesome for any type of asset. So, you know, if Bitcoin has a bad time in the short term, it will be a buying opportunity for people. that's just how it goes. Nothing goes up in a straight line forever, but we believe that Bitcoin will go into the millions and millions and millions and will go up forever.
Yeah.
But obviously not everyone shares that opinion, which is fine.
Certainly. Now you don't have to answer this one, but we're getting a question in the chat. How do retail get involved in this corporate bond? Could there be a chance in the future that there'll be some kind of retail offering? That's complicated, isn't it?
It is, but I can certainly answer it. I'll answer anything that anyone asks, as long as I'm allowed to. So if you're a high net worth individual, or a professional investor, then potentially you could contact the company and, we could involve you in a future round of this. So that's certainly possible if you meet the FCA criteria in the UK or the equivalent in the States, Europe, etc. Longer term, and this goes back to my chat with Saylor the other day, we hope and we are aiming to have products like Strategy have got in the States. So in the States, I think it was 2 weeks ago, Strategy have done a new line of stock, a preferred share, which is actually the most successful IPO in the States this year. They raised approximately, I think it was $2.5 billion in one of these additional products. But for the current size that we're at, that doesn't make sense to have those listed products, which are quite similar to our Smarter Convert. But I'm not going to want anyone to hold me to it, but in a year, 2 years, as an example, rough timeline, hopefully we'll have those similar products alongside everything else that we do. So yeah, there's options for people.
Fantastic. Well, Andrew, that's I've tried to get through as many of the viewers' questions as possible. It's always great to have you on and to see you, to get the update. Congratulations on everything so far. Of course, we have to remind everybody it's on the Aquis Exchange, which traditionally has been a little bit more volatile, can be known as being risky than other stocks, and your capital is at risk. And yeah, it's making sure that people get their head around why the stock trades at a premium to its net asset value is the most important thing, most important part of education. Yeah, thanks very much for helping us out with that.
No problem. See you soon, yeah?
See you soon, Andrew. Thank you. In the last video, we talked about earnings per share, or EPS, using pizza slices to explain how much of a company's earnings you, as a shareholder, would get for each slice or share that you own. But today, we're taking it one step further, and we're using EPS to calculate the PE ratio. And this will help you understand what a share price actually represents. The PE ratio stands for price to earnings ratio, and it's one of the most widely used tools to measure a company's valuation. But what do I mean by that? Valuation is essentially the price you pay for something compared to what you get in return. Is it worth it? Whether you're buying a car or a house or shares in a company, valuation helps you decide if the price you are paying is fair. Now, in the stock market, what you're getting is a share of the company's profits. The PE ratio tells us how much investors are willing to pay today for those earnings. But why is this so important? Because it helps us compare companies and decide whether an investment looks cheap or expensive relative to others. Now, let's take a British construction company, for example. Imagine this one block is the company's EPS, and that is £1 per share. When you're buying a share, you're buying into the future profits of that company. But to avoid overpaying, you need to know how expensive the price is. Now, too many people jump in to buy a stock just because they love the company, without paying attention to the price they're actually paying. And it might sound crazy, but a share price alone doesn't tell you how expensive a stock is. The valuation does. Now, this is the important part to get. If the EPS is £1, then how many blocks of earnings am I willing to pay for a share? What's the right price? Is it 12 times or £13? Or if our construction company's PE ratio is 14, that means investors are paying 14 times the current earnings to buy a share in the company. So the share price is simply 14 times or 14 blocks built on top of each other. Now, why have I chosen 14 times? Well, that is actually the price of the FTSE 100. Adding all the profits together of the top 100 British companies and then dividing them by the number of shares, we can say the FTSE 100 is trading on a PE ratio of around 14 times 2024 earnings. Now that looks fairly cheap relative to its own historic PE. Welcome back, everybody. That was brilliant. And thank you so much to all the new viewers that we had come in from the Smarter Web Twitter page.
Like and subscribe. Like and subscribe. So we're all out there watching it intently. If you were to, make sure you like and subscribe so we can bring you more of this good stuff.
That's right. We are the first place that you'll see every RNS every morning. We talk about it. We go through what's happened as well. So yeah, continued coverage of SWC on here. Now, before I run, because I'm off to a wedding today, I've just got to say an incredible big shout out to Hugh Carter and Lucinda Martin, who are getting married today up in Shrewsbury. A huge congratulations to you. Lots of love. And yeah, we'll see you soon.
Right, we are going to have loads. You gotta go. He's dashing out the door as we speak because we have 6 more minutes. We're counting down to the all sessions here. Just taking a look first at the wider indices because we are clearly still on that risk on mood that you heard Dylan talk about yesterday with me. FTSE down just a little, but really flat there, to be honest. But we are seeing the rest of the indices, the Germany 40s, the Germans, your Jugger still heading higher there. So are the French, their CAC 40, the CAC Caron also moving higher there. US Tech 100 up 1/3%, and also the Dow Jones Industrials up 0.2%. Let me know what you guys have been trading this morning, or also if you've put in new positions in terms of share dealing as well, because I'd love to know what you guys are investing in. A little later, we're going to have, back by popular demand, SR is back with us to talk about trading psychologies. And not wanting to reveal too much, he's going to talk about the differences between active and passive investing and the biases that are related to the two. I'm also going to ask him to take a little look at my diversification portfolio as well, because this, of course, is passive. And I'm just going to zoom in for you because I think loads of you have asked me on emails. Well, thank you for your emails. I really enjoy. I can't get to all of them, but I try to reply to as many as possible. But this is my diversification play, and you can see those big names there, also big dividend payers, of course. Now, let's have a look elsewhere as we count down to the all sessions, which allows you to take a position ahead of the Wall Street Open. We have quite a few headlines coming through already. Airbnb, you heard me talk about this earlier. We are watching that like a hawk because indications, at least in low volume here in Europe, is that it is going to fall when all session starts. Also, taking a look elsewhere, we have this is Airbnb after the company said it sees slower Q2 growth. We are, of course, also watching out for Uber. Any of you use Uber? Let me know whether you are a fan fan or not. Dylan is very much a fan. I am also a user of Uber, although I have never used Lyft. Lyft was also out with earnings overnight. Uber is talking to banks and firms. You heard me talking about this yesterday. The key thing here is what it said about its robo-taxi expansion. So I believe, Trader friends, if you spotted it too, that it said it was looking to partner up with one of the EV players, and also it announced a loyalty program and a $20 billion, that's right, $20 billion buyback plan. Saying that for Ronnie in case he is listening, because we know he likes buybacks and that rattles his cage. Lyft as well. We are also looking at Lyft because Lyft missed its sales forecast due to higher competition. We're also seeing that sort of rollback in the travel post-COVID exuberance. Many companies, not just Lyft and Uber as well, have tried very hard to continue servicing all these travel requests after COVID, but it wasn't going to last forever. You don't see shares grow into trees into the sky, as you heard the SWC CEO earlier on, but we are seeing Lyft as well joining in, chiming in with companies that have said they've seen weaker demand. Now, this is Lyft, has completed its acquisition of FreeNow, which is the European mobility platform, and they've also signed a deal with China's Baidu to introduce a search engine component because Baidu also has robo-taxis in the region. So remember I told you yesterday, the key thing to watch out for with Lyft and names like Uber is their expansion plans in terms of robo-taxi. This is the next generation of growth, trader friends. This is the next push for them. That's where the cash cow, the revenues are coming. Got 30 seconds to the bell, so I'm just getting the bell ready here. Just some of the big movers across Europe whilst we are looking forward to the US. We have, of course, IHG earlier on, but we also had the likes of Henkel, Airbnb moving higher, Wizz Air as well. Thank you very much, trader friends, for pointing that out. So we are now off to the races, trader friends. Right, let's have a look to see what is moving in all sessions. And here we are. So I'm going to zoom that in once I change the winners list. The top of the winners list, we're seeing many companies related to the crypto space. Got Micron Tech up there, almost 4%. We also have SoundHound, those of you that trade that space, up 1.7% there. SoundHound AI, of course, integrated into products that help us with voice learning and voice assimilation in many products, especially cars as well. You know I love my cars and big engines. Affirm is also up 1.5%. RSAX is still in the buy now, pay later space. Away from our numbers, good morning to you, Neil and Steve Davies as well, joining the fray. Steve Davies saying, I bought some toast yesterday. One of Josh Brown's favorite stocks, and sold out of TTD. Let's have a look at the losers list now. Airbnb, I talked about this just a moment ago, saying that it was looking like it was going to be low, and it is indeed down 6% there. That slowdown in demand being seen on Airbnb.
Apparently Rich walked straight out. So
To a wedding.
oh really?
Yeah, to a wedding. It's fantastic. Great to have you on.
Hello,
Is that,
yeah.
everyone's been asking whether you've been on holiday because
No, I've just been really busy working, unfortunately, which is not quite as fun. I was on holiday a couple of weeks ago, but not recently. But we're doing a psychology episode today, which we've
very
not done in a while. Yeah, and it's a fun one. It's one that I've been thinking about doing for a long time, actually. Should we dive straight into that, or should we? Do you want to?
Yeah, we could.
Okay, great.
Arsax has just messaged something. I wonder why it's been retracted.
Oh, but it's been
Because,
retracted.
She said Hinge Health. Maybe she's so excited to have you on.
Instantly,
Yeah, exactly.
accidentally sent the message.
Yeah. Fat finger.
So right. So today we're going to be talking about passive investing and active investing. So I guess maybe before we go into any of it, and would you like to guess in 2012 what percentage of kind of passive and active funds together were passive? 2012.
Okay.
Tough one, right?
It's a tough one.
Hard to know.
Can we I'm being told
Yeah.
do a sting and then come back because we want to segment this for our guests. Let's do that.
Okay.
I've got an answer in my head.
We'll be back in a moment. And we are back. We're back with Psychology of Trading.
Exciting because it's passive versus active.
Passive versus active investing. So the question was, what percentage of passive and active funds do you think were passive in 2012?
Okay, so 2012.
2012.
I
yeah.
would say.
Cast your mind back.
Roll back. I would say, 30%.
Yeah.
Right.
And why do you say that?
I just because I think now that we are into this realm of 2025 and markets everywhere.
I mean, we're talking 8 years before COVID.
Maybe,
it's like a
maybe
different
high,
world.
maybe like 60%. But I think what I'm trying to get at is the trajectory now is that we're likely to have more active and maybe less passive.
Oh, interesting. So the real number is in 2012. Only 25% of passive and active funds combined were passive. So it was a quarter, which is relatively low actually compared to historic. And what you find is that there are these cycles. These cycles where kind of passive bottoms out and then picks up, and then active bottoms out, and they kind of reverse. So we were 25% in 2012. Where do you think we are today?
So statistically,
Yeah.
what we've seen.
Do you think there's more passive or less passive?
In Europe or globally?
Let's say globally.
Globally. So I think there is probably less.
You think it's less than 25% passive? No. So we've actually had the exact opposite, which is we've had a massive explosion in passive investing.
Interesting.
Especially in the kind of post-2020 era. So right now, today, if you look at total passive funds plus active funds, 60% of them are passive.
Right.
So more than half.
Is this because of the cost benefit?
So I think it's basically because of the popularity of the ETFs, and that's kind of exploded. It's for kind of a couple of different reasons. Like ETFs have performed really well. So if we look at the last 15 years, would you like to guess how many years out of the 15 has the average passive fund beaten the average active fund? Last 15 years.
As a percentage?
Out of 15, how many
Out of
years?
15.
How many years out of 15?
12?
Yeah, bang on. It's 12 years in the last 15, passive has won. Would you like to guess in the 15 years before that, how many years did passive win versus active?
10?
It's actually only 5 out of 15.
Oh, really?
So basically what you go through is these cycles where passive either does extremely well, and when it's doing well, passive starts to become a bigger and bigger share of the market. And then cycles where active does really well relative to passive, often because there's more disruption and volatility, and that's where kind of the active share starts to get much bigger. So we are at the moment right around the peaks historically of the share of passive investing as a portion of the total market, and that leads to some interesting market dynamics. So there's a paper I sent you, I don't know if you can pull it up, but it's from Torsten Schlock, who's the chief economist at Apollo. He releases some absolutely amazing papers. If people don't follow him, he has an email thread where every day he will send you one chart, and it's always like really fascinating. He's a super cool guy, super interesting economics that they're doing at Apollo. But yeah, if you pull it up, you can see actually one of the things that's really interesting is they talk here about some of the impact of shifting to more passive over time. And there's 3 main things to think about, which is as the share of investing is passive, that means there's fewer people who are doing price discovery in an active way. And so what that means is it tends to lead to higher volatility, it tends to lead to less liquidity, and it tends to lead to more market concentration. So if you scroll down, if you look at Exhibit 3, you can see that passive has really exploded, especially post 2020. And that's in part because it's been fueled by people kind of doing the received wisdom of dollar cost averaging into ETFs. It's also because the market concentration has got higher, and that kind of generates momentum effects.
Yes.
Where like, okay, if most of the passive funds are going into your kind of Mag 7 names, and the Mag 7 names are growing, the AUM for passive funds are going to kind of increase compared to your active funds over time.
Now, this is interesting, Issa, because it does tie in with the explosion of ETFs that's expected in Europe over the next...
Well, so I think it's because this phenomenon is honestly a very American phenomenon.
Yes, exactly.
Like
and
the
it's
amount...
spreading.
Yeah, exactly. And so then there's a question on how much does passive have room to grow? And at what point do the risks around volatility and market concentration start to become too high that actually it starts to be a concern? And so economists have different views on what the right number is. I'm not an expert in financial market price discovery, but from what I understand, as soon as you start getting towards the 70% mark, it starts to be really concerning, because then the proportion of people who are doing price discovery is very, very small relative to more than twice as many people who are just following indices. And they tend to be following market weighted indices rather than equal weight indices. And so then you tend to be kind of increasing that concentration risk.
Right.
But what I wanted to talk about today is actually not about the trends in active versus passive. I wanted to talk a little bit about the biases and how the biases are different in both of those worlds, and how you have to be careful in both worlds, but in different ways about what you're doing. So we've spoken a lot about active trading in the past and active investing in the past, and we kind of know what some of those biases are. What are some of the biases in how people active trade, Ange?
You're probably more likely to get triggered or tilted. We talk about that a lot here, trader friends.
So emotions can be a big generator of biases. We spoke about being tilted. If people don't remember, the word tilted comes from pinball machines, which is really bizarre.
I learned that from you, actually.
Yeah, but it's used a lot in poker and it's used a lot in video gaming, but it basically means being in a heightened emotional state, which then kind of harms your decision-making ability. So that's one big bias. Another big bias is around overconfidence.
Yeah.
Another one around confirmation bias. We know that we have loss aversion. We have kind of escalating commitment to bad ideas, so you tend to move the goalpost once you've open a trade. I think those are all pretty well known. I think a second set of biases to do with active investing that are worth being aware of is people who are investing via hedge funds or via kind of actively managed money managers are often paying really high fees. So if you're in a 2 and 20 model,
St. James's Place.
Well, extraordinarily high fees, right? And so there's some interesting psychology around hidden fees and fees that are not very salient. And basically what happens is, especially for investing funds, people anchor on what the fund return is, not what their net of fees return is. And so what you find is that people then kind of misestimate how much returns they're expecting to get. And honestly, 2% fees per year, even excluding the 20% of profits, can really kill you over the longer term, kill your returns in terms of compounding. So there are kind of active biases in just generally trading. There's some biases around fees, especially if the money is actively managed by someone else. But actually, there are some biases in passive investing as well, which is kind of interesting. And this is especially interesting because, like, it's now kind of received wisdom that what you should do is dollar cost average into an ETF, like S&P, the SPY, or dollar cost average into your kind of VOO, Vanguard low cost ETFs. And those are definitely strategies that return.
Dollar averaging.
You have like a special.
I have.
Okay, can we cover some of the biases and then have a look at it? Because I'm super curious what's actually in that portfolio.
It's very simple.
I imagine it's some bonds, maybe some global.
No, it's actually more like dividends. But let's go through this first.
Cool. Right. Yeah. We'll come back to it in a second. So I think there's this received wisdom that the right thing to do is to just passive invest, and I think you should always be careful when you hear things as received wisdom. That doesn't mean they're wrong. And actually, I have a large part of my kind of buy and hold portfolio is just boringly DCA'd into an ETF. I use VOO, which is Vanguard's low-cost ETF. I think the problem with received wisdom is when everyone is doing it, then you're subject to potentially quite large volatile moves. So we've spoken a little bit about how passive investing can generate more volatility. But one of the things that's really interesting is actually passive investors, dollar cost averagers, tend to underperform the indices that they are investing into, which is such a weird phenomenon.
That's weird.
So you're like, why is that true? How can that be? Well, the answer is because during drawdowns, people tend to pull out money. And so you tend to pull out money when you're drawing down, and you tend to invest more when kind of momentum is strong and equities are going up. And so what that can mean is even if you're...
Is that because of FOMO?
Because of FOMO. So you actually are subject to the same emotional swings. So you have to be really thoughtful about what your strategy is going to be. Lots of people have automatically savings rules to kind of prevent this from being a thing. But what you basically find is that most passive investors actually underperform benchmark, which is like defeating the whole point, right, of doing passive investing. So I think that's one concern. I think the other concern is like market concentration risk. And there's two different forms of concentration risk. One is that people tend to prefer to invest in market cap weighted indices. And actually a lot of that money is now going to a very small number of companies, like your Mag 7 companies, right? And so I think people don't even, because it's passive and because you feel like you're diversified, people don't think about that concentration risk in the same way as if they're active, because it doesn't feel like it's there.
You can't see it.
You're just investing in the market,
Yeah,
right?
you can't see it all listed out.
Yeah, so I think that is a concern. And I think the second concern is that people tend to invest in markets that have done well. And so what that means is most passive investing is in the US stock market. And the risk with that is that, okay, the US has had an absolutely enormous, like generational bull run, but we don't know, like longer term, is that always going to be persistently true? I'm pretty bullish on the US, but like, I don't know, if I was looking maybe 10 years ago at a global ETF, I think I would have been more optimistic than the results would have actually panned out. And I think if I look at the next 10 years, if I look at the global ETFs versus the US ETFs, I think I would want more global exposure, especially in the kind of more heightened geopolitical uncertainty that we're seeing in the world. So I think there's kind of concentration risk both in markets, but also within markets. And so thinking a little bit about both of those things, people tend to not think about them because passive investing is a set and forget strategy. And so you're not very deliberate about the decisions or the exposure you're taking. And that can generate some risk.
So what you're saying, that's really clever, is that, you know, be careful. You need to make sure that there's no correlation once you open up the bonnet of your ETF,
or if there's going to be correlation, at least be a bit deliberate about it. And the problem actually is that people think that their brain should either be in active mode, where they're looking at everything, or passive mode, where, to be honest, they look at nothing and they kind of shut their eyes and put the money in the fund. And I think the reality is, for active mode, you should think a little bit more about what kind of passive-like behaviors are important, like thinking about different time horizons is really important. But also for passive mode, you should think about what kind of active behaviors are important, like monitoring diversification and monitoring risk.
So speaking of diversification, let me know when I can show you my...
Yeah. Let's see it now.
So bear in mind, trader friends, that I am already very... The reason for this, I keep getting asked about this, is why is it so deliberate?
So many watch lists. Wow.
I do. I love a watch list. This diversification, which is passive...
Oh, so it's passive? How is it passive?
Because I have a fund that binds them together, and I drip feed it in, right? So I've got I just pick these names.
These are names you've particularly chosen.
Yes, because I want them not to have any link to Mag 7 or US, right?
You've got a lot of energy here, you've got pharmaceuticals here,
I got relics,
banks and fintechs.
Yeah.
So this looks to me like quite a traditional, like,
divvy.
It's a dividend stock part. It's also quite a defensive set of positions. I imagine that's because your active portfolio is more risk on and bullish.
Yeah.
So I think that's another consideration, right? It's like when we're trying to think about, if you're someone who has both active and passive investment, what are the different, like, what are they used for? And it sounds like this is used for more stable income generation and volatility dampening versus your active, which is a bit more risk on. Which is super interesting.
And, you know, the thing is, these are names that I know are, you know, well-known, trusted, right? Not going to be...
and I imagine you don't imagine you will sell these names
This is
for a long time.
This is like 15-year horizon, right?
Right.
And
How
also,
do you think about some of the people on here who are like going through quite volatile periods? So Eli Lilly is a good example here.
yeah, with the whole
Because of
Novo,
exactly, yeah, with all the Ozempic and related GLP-1.
Yeah, that's a really good question. I always say, like, you know, you have to think about this in terms of your duration. That's why every time someone asks me what I think about a certain instrument, the first thing I ask is, what is your duration?
You're one of those people, Angela. They ask you a question instead of giving them an answer. You just ask them a question.
But they need the duration matters, right?
Yeah, it does matter. You're right. You're right. Yeah,
completely, right? It could be like today,
Yeah.
right? That's going to be different to, 10, 15 years.
Yeah.
And because this is this is share dealing, let's be clear. This is long.
It's unleveraged. It's long-term buy and hold.
Yeah, exactly.
You're optimizing for a totally different thing to maybe some of your shorter-term trades.
Yeah, and as you rightly said, it's more like dampening and making sure I'm not completely all my eggs in one basket with Mag 7, because you know that I have a lot of...
Yeah, and I think it's interesting to see someone like you who has quite a active trading portfolio still have quite a deliberate, thoughtful investing approach that is parallel and almost separate and thought about in a very different way. I think it's of course best practice, but it's always nice to actually see it.
Yeah. And also it helps with the emotional discipline, right? So for longer term, I would say, you can write out these blips, right? If we look at the main indices, even like let's have a look at the Dow Industrials, for example.
Yeah.
Over the long term, if you're someone who's not going to be moving, let's just go to monthly.
Yeah.
It's
I mean,
a real...
Wow, what a bull run though. That's crazy.
Other than these, blips along the way, it has... This is one way, right?
Yeah, I mean, Tom often talks about random walk with positive drift, right? That's exactly what this is. Random walk with positive drift.
Exactly. The other interesting thing, which I also do like you, is that you do voice messages.
I do, yeah.
Whereas I send messages to myself. So, for example, I was pulling this up. This is not planned in any way with Issa, because he's a very busy man, so I barely catch hold of him. But 6th of August, I have Review Sprott 496.
Oh, which Sprott trust?
Uranium.
The uranium trust. Oh my God, the miners or the underlying uranium?
So I'll show you.
I've been interested in the underlying uranium for like forever, the uranium ore trust.
So it's the uranium miners. And yes, it is coming down, but I think longer term, I am dollar averaging in.
Because you're long-term bullish on alternative energy.
Exactly. And you were asking me about my special dollar averaging in.
Yeah.
And special dollar averaging in sounds like a really uncanny way. I've done this for ages, and you might laugh at it. You might think this is not for you. Good morning, Mo. I can see you, Pelican there. MP Material, still finding hard. He came for the trading event that we were at.
Oh, cool. Yeah.
Yeah. And so every time I have a bad day or a bad moment, I think, what would future Ange do? And I then check the price. If it's down at a level that I like for either Sprott or like now I'm dollar averaging into NATO again as well, I then put 100 in. Some days would have had like 4 bad days. It's like 400 pounds straight in, right?
So it's almost like it's like a gift to your future self.
Gift to future Ange, right? Obviously, don't do it blindly. I wait for like a day when the share price is down to a level that is amenable.
Sure.
But you can't call a top, and it's impossible to call a bottom.
For sure.
So
we actually just got a great question from Arsax, which is, in indices, non-performing stocks are replaced. So I actually think this is the benefit of passive ETF-based investing, right? Is that actually the ETF does well over time because its composition changes to reflect who's doing well at that time. And so I think it's a spot on point that is the benefit. There is some interesting inefficiencies with ETFs, which is often...
Tell me.
Well, so there's this fact that basically to get into an ETF, you have to have basically recently had a bit of a run up. So what that means is if you're looking at index rebalancing, on the margin, it's a very small effect, but on the margin, there's a bit of inefficiency because the companies that are being added to indices generally have just come off a really strong run, and companies that are being pulled off the indices, have just come off a weak run. So what that kind of means is short term, you're doing a bit of buying high and selling low, which is obviously never good for your returns. But actually that's a very, very small effect. So I think it's something like, if you look at the last kind of 30 years or so of indices, your average return in the US is something like 9%. The index rebalancing has an effect of somewhere in the region of 0.3 or 0.4% of a hit to those returns, which is not nothing, but it's not totally crazy. And so I think part of why those returns are so consistent and so robust has been because the non-performing stocks are replaced. The problem we have is that actually that leads to concentration risk. And so you have Mag 7 taking up a bigger and bigger share. It's like something.
It's hard to get away from it. You know?
Right. Well, it's
really
more
hard.
than $1 in $3 that go into an ETF are really just going to a very small number of companies. And so I think the question you really have to ask yourself is, what are you passive investing for? Is it for growth? In which case concentration might not be your biggest concern, but then you have to be super careful about not pulling it out during drawdowns. Or are you doing it for diversification, in which case maybe you want to look at an equal weighted index. I actually invest in S&P equal weight recently. I think that's a nice alternative hedging option. Or you can look at global indices rather than just US focused indices.
One other interesting question that we had as well is that, is there an optimum time? Let's say you're not dollar averaging and you want to like put one huge chunk into an ETF, one go. Is there an optimum time?
Was it the famous phrase, time in market rather than timing market?
Yeah.
I think the traditional answer, so a lot of the original research done by this was done like quite a long time ago by a bunch of economists, and then the original paper that was written was then read by a guy called Jim Bogle, and then Jim Bogle was the first guy to design an ETF, and it kind of exploded in popularity. There's a funny subreddit called Bogleheads, if you're interested, of people who just do ETF investing.
Nice.
But essentially, I think the idea is the earlier the better. And the more patient you can be, the more you can feel confident about longer term getting those returns. I think the reason you would dollar cost average is to try and mitigate some of the short term volatility that you would get from kind of a lump sum investment at any point in time.
Here we are, just putting up the Bogle heads. Is this the one?
Yeah, exactly.
Fantastic.
So these are people all talking about ETF investing. You can also go to reddit.com/r/bogleheads, and then that will also have a bunch of like people talking about how to do ETF building and portfolio building.
Nice. Some of the ETF peeps that I know said if you're putting in a big amount, they say the rule of thumb is to make sure you try and miss high volume periods. And by that, they mean, don't do it at the very start of the European trading day or the Wall Street, open.
I just
try and...
I'm sure there's like good back testing of this. It's all too sophisticated for me, which is why I think for my passive stuff, in or out, like DCA, like trying to automate to some degree. I think that helps mitigate some of the biases that we spoke about.
How about risk tolerance? We talk about this quite a bit, right? Risk reward. How would you quantify sort of, whether or not the risk tolerance and management for active investors, do they in general take on higher risk, right, than passive investors?
Yeah. Well, I think most active investors have a portion of their money passive. So I think you really have to think about risk in a few different dimensions. There's risk in geographic risk. Are you like overly concentrated in certain markets? There's risk in terms of asset mix. So are you long bonds as well as long equity? If so, what is the ratio between those things? Are you long crypto? What's the share of your portfolio that's crypto because it's more volatile? Are you long commodities? I think a lot of people have absolutely no commodities exposure. And so I think thinking about your asset mix is really important. I think the third thing to do is think about the mix between active and passive. So if you're doing both, do you think like you should have like 50-50, 60-40, and how do you think about what the mix is, what will impact that mix over time? And then having the discipline to regularly reassess if that makes sense is really, really important. So I think all of those things key. And then within your active portfolio, we always talk about position sizing is like really important. So if you're feeling like any one position is too much of your portfolio, downsize, and then think about your risk management, think about your time horizon, think about pre-agreeing your exit plans, and like understanding the thesis of why you're making a trade.
Sending messages to future Ange.
Yeah, exactly.
Speaking of which, do you prescribe to the, Rich and I get asked about this a lot, and how often do you look at your passive portfolio?
I look at it
like going to the dentist or the hygienist.
I look at it once a quarter, but I only make changes to it once a year.
Oh, interesting.
And yeah,
because
I think because I like to check. It's probably a bad habit. It's one of those funny things where, like, as a psychologist, I know checking things like a passive portfolio more frequently actually just generates negative emotional sentiment. So, but I still do it because it's a bad habit, and because I'm someone who likes to have the information, I tend to do it.
Yeah.
But I try to only make major changes to the portfolio once a year. You do it on Halloween, is that right?
Well remembered.
Yeah.
It's such a good memory. It's unbelievable. You're my phone friend.
Yeah.
So the Halloween thing has this method in my madness.
Right.
Halloween, number one, is easy to remember.
Yeah.
Right. Second thing is it tends to be the time that precedes.
Right.
I know we talk about Santa Rally. We've demystified that. We've debunked that theory. But
So I do my once a year annual changes when I have ISA season, because it makes sense for me. I'm adding money to an ISA. I'm thinking about if I want to swap provider, like what the mix is.
And it kind of times in with the autumn budget, right?
Yeah, exactly. Yeah.
But also I look at it again in August, which is this month. Because we're in that
Have you done it yet?
lull period. I've started looking into it. I've got a bunch of paperwork in my bag. All this. If you had,
You're pulling out the old DCF models.
I go, wow, right? And then the stocks and shares ISAs that change around, because it's also that time of year when you might have that correction.
Of course, I think volatility is a bit kind of higher, volumes are lower. You can kind of see it. We actually got a question from Julian, which is, do you think the market, we are being steamrolled by passive investing at the moment? Do you think that's a big factor? I think passive definitely contributes, in my view, to some of the momentum-based effects that we see.
Yeah.
But so do active momentum-following trading strategies, right? So I think it's hard to know how much is passive versus not.
Yeah, it's hard to, I've been trying to get numbers on that, but it's hard to weed it out. But clearly, maybe, I've been thinking about this, maybe the support we've seen on the markets recently might be passive supporting it.
Well, yeah, I think it's, there's Mike Green, who's a writer and commentator in the space, talks a little bit about how passive is a giant mindless robot that just kind of buys and buys and buys. And at the moment, the funds are coming in, but there will come a date in the future where actually people are slightly older, they need to start withdrawing from those assets. And so then we might see at some point the giant mindless robot go in reverse, which might be very, very risk off as a sentiment.
Yeah,
I think
so
at the
watch the
moment,
cycles, Julian.
yeah, at the moment it definitely is a factor to consider, in the same way that buybacks are a factor to consider, but I don't think it's driving the entire market dynamic.
Yeah,
in my view.
Phil's going to kill me, but I know this is a question that every one of you trader friends have been asking, so I'm going to ask it for you because I'm interested in this too. Do you still buy into the whole, at this age, you're going to have to try stepping out from the more risky assets, and then when you get to a certain age, you have to move it all.
Start to buy more bonds.
Yes. I have great difficulty with this.
Oh yeah,
why? If I know something is going to still, like AI, and Dylan and I talked about the AI supernova yesterday. I'm bullish, right? I just think there's still got legs to run. Still the legs run, right?
Yeah.
I'm kind of like, I have a difficulty in pulling out if I know.
So I think almost never are people who regret taking profit to some degree. So I think I talk to my dad about this a lot because he's been in the market during this unbelievable bull run. He's in his 60s. He is now not generating income in the same way that he was when he was working full time. So I think in his case, I kind of do feel like it's reasonable to slightly reduce risk. We're doing that in a couple of ways. We're looking at different markets, so we're less exposed to the UK and the US. We're looking at bonds, but we're also still in equities. We're just slightly lower risk equities, or the exposure of the whole portfolio is slightly lower risk.
Yeah. Great.
He's still very bullish though. Yeah.
So I need to meet your dad.
Yeah.
All right. On that note, thank you so much for being with us. Any other
worries.
questions just send them to me. Hit the like and subscribe button and send those questions. And I'll get them in from Issa for you. Have a great day, guys. Happy hunting. And do hit the like and subscribe.
In the last video, we talked about how the S&P 500 has a higher PE ratio than the FTSE 100 because investors expect faster earnings growth. But let's look at what happens when those earnings actually grow and why that makes such a big difference. Here's the S&P 500 in year 1. Its PE ratio is 24 times, which means investors are paying 24 times the earnings to buy shares. This tower represents the share price. The height of each block reflects the unit of earnings needed to support that valuation. Now, let's jump forward to year 2. The share price hasn't changed. This tower is exactly the same height, but look what's happened to the earnings. Each of these larger blocks represents higher earnings compared with the smaller ones from year 1. Because the earnings have grown 50%, what used to be 24 times earnings in year 1 is now only 16 times earnings in year 2. That's a huge improvement in valuation, even though the share prices have stayed the same. This is the power of earnings growth. When companies deliver stronger earnings, the PE ratio naturally comes down, making the stock look cheaper, even if the share price hasn't changed. And when investors see that kind of growth, they're more likely to stay invested or even buy more shares. And that's what pushes the PE ratio back up. And that's what makes shares go up or down. Now compare that to the FTSE 100 where earnings grow more slowly. Even if the share price stays the same, the PE ratio doesn't improve as dramatically because the earnings aren't growing as fast. That's why growth is such a critical factor in investing. It's what drives long-term value. So here's the big lesson. Earnings growth doesn't just boost a company's value. It makes the stock more attractive by improving its valuation over time. As an investor, the holy grail is to find companies that can grow their earnings by more and for longer than other investors may already expect. This may even mean avoiding shares that are already very popular, overowned, and potentially overvalued. Because if a stock on a very high PE ratio misses its earnings estimates, then the price can come crashing down.
Welcome back to Man vs. Machine. This is the show where a multi-billion-dollar AI system goes head-to-head with human intuition to try and answer the question, should you take investment advice from ChatGPT? So to recap how this works, it's pretty simple. We've got some basic rules in place for consistency. Each week, Aaron and I put ourselves in the shoes of a UK investor and we try and ask ChatGPT for investment guidance. We use just 2 prompts. The first is a market analysis prompt and the second is an investment allocation prompt. We then take that AI portfolio and we try and enhance it ourselves. 2 weeks back, we built the first foundation portfolio using those prompts. And then in episode 2, just 1 week later, ChatGPT went for a rebalance. So Aaron, let's pick up where we left off last week.
Absolutely. So if we just put our slides on screen, you'll see that these are the current rules that we have for the portfolio. So if we just go back one slide, perfect, thank you. We can see that we provide a comprehensive rundown of market conditions, which the AI system provides. We then give the AI, a prompt to make any changes to the portfolio, and then we see and implement those changes into our system. And these are the rules. So long only, no leverage, max 50% in one ETF, max 20% in one stock. And we're up against the 80% world, equal weight world, plus 20% in cash. So a mixed index, which reflects broadly our asset allocation. If we just dive into results, well, firstly, before the results, here are our holdings in the AI portfolio. So that's our latest portfolio composition. So 80% in equity broadly, a little bit in gold, and also a little bit in short-dated bonds.
What changes did we make on that AI portfolio last week?
So prior to that, we introduced gold, and we also introduced the UK dividend fund, which was on AI's suggestions. So yeah, some interesting changes there. And this is our human portfolio. So this is the one that Martin and I have constructed. We've gone for a more geographical spread of assets. So, across FTSE, Europe, emerging markets, NASDAQ, with a little bit of thematic exposure in defense, one single stock in Shell there. And I think we're going to go into the results a little bit. So here are our results for the week. So, we're outperforming, most importantly, since the inception date. So we're up 0.7%, above our benchmark, and also, most importantly, above the AI competitor we're up against. The past week, we were down slightly. So was AI, so was the benchmark. We're down just marginally. So that's, underperforming the benchmark slightly, and also underperforming AI, but only 4 basis points. So,
in the last week, we've underperformed both benchmark and AI. Well done to AI, almost hugging that benchmark.
Yeah.
What are we thinking at this point?
Well, I mean, it's quite interesting to look at the benchmark, because we know that, as I mentioned before, and as you can see on the screen, it's 80% world equal weight, 20% in cash. So it tends to be slightly less volatile, because we don't have huge amounts in one indices that many other indices have, or benchmarks have. If we look at just the world index, it's something like 60-70% US stocks. This will obviously it will be slightly higher than that, because US equities have performed strongly, so before this index is rebalanced, that it might have a little bit more exposure, but it's not going to be as high as 70% exposure. And we saw the US have a bit of a wobble last week, which is sort of reflected, I think, both in AI's performance and the human performance. So we're both at the behest of US equity wobbles.
I think exactly what you're talking about in terms of US wobble. Some bit of cautious news last week. We saw Trump also firing the person who collates all of the economic data, also choosing to move 2 nuclear submarines into Russian waters based on some sort of aggressive tweets. I think he posted that on Truth Social. I think let's get into the meat of this, though. On performance.
Yes.
I think you've prepared something for us.
Well, I think we need to ask ChatGPT what it thinks of our performance or theirs. So I'm going to ask ChatGPT now, because we've got a live one with us. ChatGPT, what do you think of the human portfolio versus your portfolio so far?
Hey there. Sure, let's dive in. On the human side, I think their portfolio is showing some solid decision making. They've managed to maintain that slight edge, and it looks like their picks, like those US tech stocks and maybe a bit of that defensive positioning, are paying off in the longer run. It's a good mix of growth and some stability. As for the AI portfolio results, I'd say it's doing pretty well overall too. It's only a bit behind the human portfolio, and it's still outperforming a benchmark, which is a good sign. The thematic picks like clean energy and defense have their ups and downs, but they're still contributing positively. In short, both portfolios are doing a pretty good job so far, and it's interesting to see how each approach is playing out.
Okay.
So I think AI, not only is it beating us in the portfolios, it's also ready to take over the show.
Well, I mean, I'm gonna.
What a delivery!
I'm gonna disagree. It did say that we made some solid decisions in our portfolio making, which I'll take as a very strong compliment from ChatGPT. So thank you very much to AI for complimenting us. But also, I think we better now decipher why the portfolios performed as they did, and sort of go in a more granular view. So if we put up the performance drivers of, firstly, AI, we see that gold had a really, really strong week last week, and some of the individual stock picks also did well, so Lockheed Martin and so on and so forth. But one I want to touch on is the UK dividend, which was a new ad. Only 50 stocks in this ETF, and it just had a really strong week. It's got some really strong names: Legal and General, Aviva, some of the big insurers which have done well recently.
So I think for the viewers, what is the UK dividend ETF doing separately to just a FTSE ETF?
Well, it's probably screening slightly more for quality, I'd say, this ETF, this index as well. And it's just going for more higher dividend paying companies rather than some of, even though the FTSE is known for, and UK stocks in general, when you compare them to American stocks, they do pay a chunkier dividend. This will probably look for the highest paying dividend stocks.
Yeah, so we have a dividend yield ETF filtering for stocks that pay higher dividends. I think FTSE typically is about 3.5% dividend. I think this dividend yield ETF just over 5 at the moment.
Yeah. And then if we look at some of the performers which haven't done so well, as we mentioned that AI has got a large position in the MSCI World, which has got a large position in US stocks, and they had a little bit of a wobble, as we mentioned earlier on, throughout the week.
Yeah, I think it's the first 1% move down in the S&P in as long as I can remember. It's been a number of months since we've had a 1% down
since the April tariff debacle. That's when we were getting masses of volatility.
We've got an 8% down there. Great.
Moving on to the human performance, we obviously have gold as well, which has performed well. Our defense ETF has done well, but now you can actually see where we didn't do so well for the week. So, as we mentioned now a couple of times, the US had that wobble, and the S&P 500 sold off, but also the tech-heavy Nasdaq, which was really at the behest of rate concerns about economy, and it's a more volatile index, I'd say, because it's more weighted towards that technology sector, which is why you can see it's down another 20 or 30 basis points relative to the general S&P 500, which is a more broader index.
So, I mean, we've obviously got a lot of earnings coming out, particularly in tech stocks. We're coming up to the consumer stocks later this month, the likes of Costco, Walmart, Lowe's, Home Depot. Why is the tech stocks, you mentioned rates, why are they so sensitive to rates?
Well, tech stocks are stocks which are, are growth stocks, which are, hoping to grow their cash flows, and a lot of their valuations are propelled by future cash flows. When you have a change in interest rates or projected interest rates or concerns about interest rates not coming down, it does something called multiple compression, where the stock price can then, if it's trading at a high multiple, that multiple can compress and there can be a sell-off within that stock. So that's something that you can often see, particularly in tech stocks and particularly throughout US tech stocks. We saw that most notably in 2022 extensively. So that's, a reason why that sort of indices is quite rate sensitive.
Yeah. I think we've got one slide to put up that compares the two portfolios with each other.
Exactly. So now you can see that we had a few more down components relative to that, and even one stock that we have in our portfolio had it actually had a decent earnings, but I think it came in Shell. Came in slightly below expectations. It's proceeding with a buyback program, but it was down slightly after having some quite sensational performance, I would say, since 2020, when it was trading at around £10 a share. It's now around that £24-25 a share. So if you're a shareholder in Shell since the 2020s, if you're purchasing it then, I think you'll be probably a very happy investor.
Yeah, but over the past week, buybacks, I think we're now at about 70% of US stocks have now actually exited the blackout period, where they can now start buying stock back. So could see some support in the market just from that.
Absolutely. And then, something which is I guess done quite well for both of us over the past week, especially when you're looking at down days, is our ultra short bond, which is basically a cash proxy, and that, stabled the ship slightly when things began to look a little bit red in our portfolios. So
yeah, very, very interesting. I think let's now move on to what we want to do for next week. We asked ChatGPT the same two prompts. The first prompt we asked ChatGPT is to give us that comprehensive view of the market.
Yes.
I think we've pasted in what its reply is.
Yes, and I think it's time to ask ChatGPT the next question. So ChatGPT, what do you have planned for next week based on your recent performance and upcoming global economic outlook with the new tariff information in particular?
For the upcoming week, given the recent performance and the global economic landscape, I'd consider a few adjustments to fine-tune the AI portfolio. One, trim some volatility. I might reduce a bit more of the clean energy ETF exposure, especially if there are concerns about tariff impacts on renewable energy components or supply chains. Two, increase defensive positions. Adding a bit more to UK dividend stocks or short duration bonds can help cushion against any market volatility, especially if global economic data or geopolitical tensions increase. Diversify with a hedge. Introducing a small gold allocation could serve as a hedge against inflation or unexpected market moves. Monitor global economic indicators, keeping a close eye on upcoming economic data releases like inflation reports, central bank announcements, or changes in tariff policies will help in making timely adjustments. Overall, the goal will be to remain flexible, reduce some risk, and ensure the portfolio stays well positioned no matter how the global economic environment shifts.
Yeah, so it's quite an interesting response, I'd say. I mean, these were obviously some of the prompts that we spoke about and gave it. So it talked about, that UK stock market being attractively valued. It talked about global markets having high valuations, interest rates, commodities. But some of the allocations it's suggesting are so different to what it originally came up with, which I find quite interesting.
Yeah, I think after 1 week already willing to rebalance, week 2, we have a fundamentally different portfolio to what we started with.
Well, exactly.
Snapping at the winners, I think that is what I have picked up. As soon as the stocks start to rally a bit, likes to trim them.
I just want to provide a little bit of context in some of this text that it provided. So this is straight out of AI, and it's market summary that we gave it. It says that the UK economy is growing moderately. It actually contracted a bit in May, and it only grew 0.7% for the quarter. So I think it's some of the data that's come out of it is slightly misconstrued, perhaps. So that's why I'm always team human, certainly for this task, because we can have a look at lots of different data and make decisions based on that. And I will 100% agree with it, though. Valuations in the UK are attractive, but is the UK economy growing moderately? Well, I think it's been showing signs of a little bit of wobbly.
Easing inflation and stable consumer demand. Looking forward to see whether that gets picked up by Andrew Bailey later. We have our rate cut. What are your thoughts on that? I don't know if we could ask ChatGPT if we're getting a cut.
Well, I think, look, the UK, I think, as we've discussed, likes to follow what America does. America hasn't cut yet in this sort of latest. I mean, it's cut since its peak, but it hasn't cut recently, and it's held rates. So I would expect the UK to hold rates. I think if you ask different financial publications and different financial strategists, you'll probably get 2 different answers. But I think a hold looks the most likely, and I think they might cut rates further along the line, maybe in a couple of months or so. Are you on the same page?
I think I'm expecting a cut, but I'm not going to be surprised if there's a hold. I think that's just for all the concerns you mentioned.
Of all the central banks, the Bank of England tends to surprise me the most. The US, I think, often comes in line with expectations, but I think that when I've expected, rates to be raised, they've held, and vice versa with cuts. So it's quite interesting to see. So I look forward to that in a few hours' time. Think now we should probably have a look at what they're suggesting for next week.
Let's have a look at the rebalance portfolio. So this is prompt 2.
Yes.
Based on that market information that we just got from ChatGPT, what do you make changes to?
Yeah, so we heard from ChatGPT that it wants to add defensiveness. It said defense, but it was talking about portfolio defense rather than defense stocks, because it's actually decided to trim defense stocks, ironically. So perhaps not the best use of words from ChatGPT there. But we can see that it's trimmed defensive stocks, and it's also trimmed a little bit of cash, which is quite interesting because it was talking about being defensive, but it's cut cash by 3 percentage points. Allocated a bit more to gold, which I think is quite a sensible move. We've done sort of similar when we started the portfolio. Added UK domestic growth. So the FTSE 250, this index tracks, it's a Vanguard index. So you've got companies like Burberry, Greggs, probably Watches of Switzerland, those sort of companies, really, small mid-cap.
All right, yeah, so we've got 2% now in that UK mid-cap ETF. Fascinating that it's, I think when you've spoken to them, we've told it's a UK investor.
Yeah.
I don't know if that is maybe getting at this exaggerated UK move.
Potentially. I mean, there's some good companies in there, but it's a really high beta position. And what that means is that it can be quite sensitive to data, to changes, to market moves. It's more sensitive than maybe a more defensive position.
What is it really so sensitive to?
Well, it can be, firstly, interest rates, growth, sort of even geopolitical conflict news. They're more sensitive equities on aggregate and in general, I'd say. Added a little bit more to the UK dividend. I felt that it probably, from its perspective, imagined that its UK bias was probably too small for its liking. So that's probably why it decided to add to that region. Anything that surprises you?
I think the same message, which is just, that cuts in Lockheed Martin been performing really well for it. Next Era Energy, that performed well in week one.
Yes.
Cut down on that. Lockheed Martin performed well. It's now cut down on that. So really quick to take off some of the winners. Interesting to see how the base of that portfolio was this capped world ETF, very diversified, and now going for even trying to get some more, as they mentioned, defensive positioning, diversifying further. Let's see how this performs.
Yeah.
I think we've got 2 weeks worth of not backtested data, 2 weeks worth of performance data. So far, we're up slightly. Let's see how this works out over the next few weeks, months, years.
And even though we did marginally underperform the benchmark and AI over the week, portfolios are built for years of investment performance, 2, 3, 5, even 10 years. So of course, you can look at any performance of any financial asset, and if you take a certain environment, it will underperform in certain situations or certain time periods. So, it happens.
So what you're saying is don't fire your financial advisor for ChatGPT yet.
Well, yes. I mean, underperformance happens. It's the long-term picture that as investors we tend to look at, and that's the most important thing. And investing in equity markets is often a long-term endeavor for investors if you're not a trader. So yes, I mean, really, really interesting to see some of the changes this week, to see that it's still maintaining that core world position, and it's also maintaining its emerging market position. So it's interesting to see that it's probably understood that the valuations are attractive in that area, and it sees that future growth trajectory.
Yeah. The physical gold position as well started off first foundation portfolio, no gold, and each week it has now added a bit to it. So it's definitely, I think, in the news that it provides, concerned about geopolitical risk. I think the news that it gives when you ask for a market update is quite simplified. It's very economic heavy and not kind of financial markets heavy. And I think that element of it really delves into, it keeps wanting to give more geopolitical hedge.
Yeah, and that's quite interesting because it understands the core tenet of portfolio building, which is diversification, not putting all your eggs in one basket. But I'm interested to see how it does next week and see what the Bank of England does, and see how we perform next week. See if we can continue to outperform the AI portfolio and the benchmark. So that's all we have time for. Thank you very much for catching this episode, and we'll see you after the break.
Stock, shake it off. It's Wednesday. It's August 6th, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak's in San Francisco, Mike Butler in studio today, sitting in for Dylan Radigan. He's in Chicago. We're here to take you through the rest of this hour as we wrap up the trading day. Futures market closes at 5 Eastern, 4 Central. As always, you can follow us on the platform Tasty Trade on the website tastylive.com. Come over to YouTube. Mike's manning the chat. Tell us what you think of this action. What do you think of that bond market flash move lower this morning? Not sure what that was about, although there was a pretty terrible 10-year note auction later in the day. Doesn't matter to stocks. S&P 500 up by 1.2% and change. S&P 500 scaling the wall of worry itself. Not sure if it's an impressive day for the broader market because the breadth is pretty bad. Russell lagging the pack, most sector ETFs underwater. Instead, our attention turns to Ilya's beloved US dollar, which is punching both him and I in the face.
Yes, it is.
Gold, silver are perking up a little bit here. Obviously, lots of corporate intrigue with earnings out over the past 24 hours. But Mike, we'll start with you because you're our returning champ here to Overtime in the guest spot. We have a market here that's quite resilient. S&P 500, 63.71 on our screen. What say you about this market moving up as we make our way through this first week of August?
Sometimes you just got to close your eyes and smile and just buy every dip you see. I don't think I've seen Tony so happily bullish before. It's very, very rare from last call. But yeah, I mean, when we had the initial sell-off last week, the first thing I did was look at volatility futures, and they were basically not moving. They were up a point, which is basically, for me, that's nothing. If we were to have seen that sell-off and maybe 3 or 4 points be infused into vol futures with maybe a little flattening of the curve, I think that's more telling of a continuation there. But now we're seeing the dip bought in every avenue. Like Apple's was up $10, $11, $12 today. Amazon up almost $10, just reversing the woes of the earnings results from last week. So the market is telling us we should see certain things, and we're seeing it. And so I guess it's that. I guess that's the environment we're in. I feel like we've been there for the whole year.
Dylan's not here, but I think we're recreating him in the aggregate, Ilya, from yesterday.
It does seem like it, doesn't it?
Yeah, Mike, I don't know if you saw Dylan's rant yesterday. He berated Ilya in all bears. Even as a fellow bull, it's like, please stop. He's already dead. But Tony's pretty bullish, and you're bullish. So, Ilya, we don't have
and
a Dylan
I'm unrepentant.
Today, and you're still sitting. Okay, so why is Mike wrong?
I mean, just take a look at the chart of the S&P and tell me what has actually happened. But
it's like a Rorschach test, Mike.
I mean, let's just put a horizontal line through 6,400 on the S&P, and you tell me what has happened. But it's not exactly rocket science. Last week, we established a range. We broke through that range. We remain under that range. We have gone absolutely nowhere but for about a 50% rebound off the lows on Monday. Yesterday, we went a little down. Today, we went a little up. It's a new range we're carving out, and we're consolidating. In other words, the markets are net down off the high, and we're waiting for them to see if they're going to attempt to make a run at offsetting or invalidating that breakdown, or if after what is a textbook retracement after a big move, we're just digesting before the next decline. Have we broken the series of higher highs and higher lows going back to the latest swing bottom in late June? Yep. Have we undone that break? Nope. So what exactly about this price action today tells you anything has changed between the end of the day on Monday and now? Nothing. Zero.
All right.
Oh yeah, I'm a little pissed at you. It feels like you're like, come buy some puts. We'll have a laugh.
The water's fine. The water's fine.
And if I was just amoral and mindless like Dylan said we needed to be several weeks ago, things would be going a little bit better. I kid, of course. I mean, not really. It's not like I sold at the low, so I'm not really feeling the pain. But there's a resiliency to this market. I mean, the Apple news today, Mike.
I mean, again, is there? We're down from the high last week. We haven't come back to retest that high. Where is this resilience? Because the market is
Apple's
up a
up.
day?
Apple's up, Ilya. Apple's
at the
never
top
up.
at the top of the range where it's been stuck since early April. Again, where? What is this resilience that we're talking about? Where is it? Show me.
So, Mike, this is my quip with today's market, and I want to give the devil his due, although Ilya's, well, we'll leave that up to the audience. But 10 of the 25 sector ETFs are in the green today. That means 15 are red. And I couldn't help but notice in today's session, when we look at something like SPY, for example, it's up by 0.75%. Our RSP, the equal weighted in S&P 500, is down by 0.2. Same thing for the triple Qs, up 1.26, QQEW only up by 0.49. So that doesn't really seem like a healthy market, so to speak, kind of fake looking at the top level. Does that concern you that there's not a lot of participation with today's rebound?
Yeah, I mean, I think it's always cautionary when you have a couple of names driving what feels like the entire move. And of course, under the hood, there's definitely some issues. I mean, looking at the Fed Watch tool, this completely flipped. This is totally inverted from what we saw a couple weeks ago, where we weren't projecting cuts, and then one day everything flipped. Now we have a 95% chance we get a 25 basis point cut. But I stand by, prove it to me, do the cut, actually do it. But we'll see. Maybe the market is kind of timid until we actually see the cut happen. Strong possibility that it's going to, but this year and last year, it's just been kicking the can down the road. So I think if we do get the cut, I think that's when you may see a lot more volatility in all these names that are in these indices, and maybe that's when we get the macro move that we're looking for, where right now it's kind of just this low vol chop. But that would be a little depressing because we're over a month away from the next decision.
One thing I think, I was doing this as I was getting ready for the Bank of England rate decision overnight, but it's important to remember the Fed cut rates by 100 basis points last year.
What's your process for getting ready for the Bank of England? Do you like brush your teeth, haircut?
That's later. Here I'm just updating charts, looking at what's priced in, getting my pound shorts ready. But as I look at this, they're widely expected to cut. And of course, the president is going to crow about it, like he did the last ECB cut. This cut for the Bank of England will be the first one that actually gets them a hair ahead of where the Fed has been since December. The Bank of England has been cutting longer than the Fed, but the Fed has cut more. Last year, the Fed cut by 100 basis points. We should be starting to see that begin to filter into the economy right about now. And the second quarter GDP numbers gave us the weakest 6 months of consumption this year since the first 6 months of 2020, the COVID recession. So the macro situation in the US looks pretty awful if you kind of consider things in context. The jobs report, awful. The ISM numbers, awful. The consumption numbers, awful. Inflation, back up. The reason the Bank of England is so interesting is they're in a similar boat. Inflation is up, growth is cooling. Only now will they take a step in the direction of outpacing the Fed by 25 basis points, but they're only baked in for this cut and one more this year and the third next, which is way less dovish than what's on the menu for the Fed this year and next together. So you look at this and you go, okay, well, should the Fed be cutting? Markets think so. But it's not like they haven't been, and it's not like we shouldn't be seeing that stimulus. And yet it's not here. So what does that say about the underlying economy? And is it actually weaker than meets the eye because the stimulus is starting to have an effect to some extent?
How much per year will the tariffs cost you as consumers? Do we have an estimate for that?
I think we're going to find out, because the tariffs are such a black box at this point. I mean, obviously, we're waiting for this cliffhanger this week. Maybe we get another thing that happens. Maybe there's another announcement. Today, India caught a 50% tariff. So we'll see. I think the essence of why the Fed is dithering is nobody knows.
In the United States, there are 128.7 million households. That's according to latest census data as of end of 2023. The Yale Budget Lab is projecting that the median American consumer household, family of four, is going to see about $2,080 in charges. So we're talking about a $250 billion hit to the economy. That's considerable. You know, one of the reasons why lower rates may not
numbers make sense.
I mean, that may be one of the reasons why we haven't seen the interest rates flow through, because interest rates would be helping, say, small business formation. But if you're a small business right now and you only have one supplier and you don't have the ability to stock inventory because you don't have the facility, because you don't have the balance sheet, you're just screwed. It doesn't matter if lower rates are coming around the corner. You can't operate in this environment. So maybe the lower rates they don't make a difference this time. But there are encouraging signs, right? I know this is a lot of idiosyncratic related risk today because telecoms are surging to a new all-time high. Consumer discretionary is on the up and up here. Mike, these aren't exactly hallmarks of a bear market. When the tech names, when the consumption names, when XLK, this is a new all-time high close this week if we were to close at these levels. How are you managing to ignore the noise, ignore this? Maybe you ignore seasonality all the time, but how are you staying on for the ride right now? Because I found that to be very difficult. And quite frankly, I haven't been involved since Thursday.
I am trading live cattle futures.
That's what you got to do. Man, yeah. I've been sleeping.
Yeah.
That's what you got to do.
I mean, I've definitely increased my exposure to futures products. So I have wheat position, corn position, micro natty gas, micro crude, live cattle, and gold. And that makes up like half of this portfolio. The rest is just sizing down, doing more diagonal spreads, calendar spreads, some iron condors here and there. But yeah, I don't think anything really changes. I'm more prone to taking risk off with smaller winners, especially if they're to the upside. Like Apple, I had a call diagonal spread, got bailed out today, took that off. Amazon, if we see another day like today, that'll be a bailout too. So I'm just basically shifting slightly and by way of taking off winners if they're smaller winners and I get them quickly, and adding more neutral to bearish positions in SPY and SPX. So I had a put diagonal spread that I put on in SPY, took that off when we got that 100-point sell-off last week. That was like a $200 winner there. And I still have an SPX iron condor on. That is, I have my short call spread at 6,300, 6,310. So I'm still leaning short with some positions. But yeah, I think keeping risk small, keeping cash on the sidelines, and really just being patient enough. Luckily, football's around the corner too. That'll give us something else to look at. But you just have to be patient and wait for this thing that's going to happen. Because if you're not, I think it makes sense to be positioned for a grind higher up and to the right until volatility picks up. Because there's just no way that the market sells off 5-10% if we're still in the teens in volatility. It's just not going to happen. So
yeah, I mean, Elia, it's low volume, it's low vol. If the markets are, I mean, you and I went through this exercise, and for the sake of intellectual, which one of these notes is it on my desk? Not you, it's you. Monday, NASDAQ, you had 23,300. You pointed out 23,365 as a line in the sand. Russell was 2210, and the S&P was 6365 on Futures Power Hour. I see markets that are basically on this. All three of them are on the other side of those levels. So what are we actually hanging on here for if we're trying to be a little bit more conservative? Why not switch to directionally neutral as opposed to being outright bearish?
Because the vol isn't juicy enough. To Mike's point, you go directionally neutral, and what are you actually doing? The IV rankings here are not really giving you much to extract. So, in my mind, again, you had a sell-off last week. That sell-off has not been invalidated. We have seen a little correction in that sell-off that is textbook in line with what you would expect, where we came back to scrape the underside of the range that was broken. It's the first page of any textbook on technical analysis, but never mind technical analysis. Let's not get that complicated. You had a range. That range was broken. The underlying assumption there is, oh, okay, something different is going on. Have the markets shown you that something different again is now occurring? No, they haven't. So what is it that you're doing here? Well, from a risk-reward perspective, you have a ton more room on the downside than on the upside. If last week's topping signal is wrong, and maybe it's wrong, I'm not married to it being right. If it's wrong, you're wrong fast. If you're right, you're asymmetrically right by a lot. Vol is cheap. Puts are cheap. Duration is cheap. The thing to do from a risk-reward perspective, it seems to be the most obvious thing in the world, is to be a little bit short and see, because you can buy put verticals here that are risk-defined for not even peanuts. And you can give yourself tons of duration to dilute your sensitivity to near-term delta and make this very easy to float. So if you're going to do anything, you have to be risk-reward minded and price action minded. Forget whatever you or I or anybody else thinks about the economy, the tariffs, blah, 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 blah. What's the price action say? We had a breakdown that isn't invalidated. Vol is cheap. Risk reward is asymmetric. This is not rocket science, as far as I'm concerned.
Yeah, to Ilya's point, the put diagonal I had on in SPY. So SPY IV rank low, implied volatility in 17.8 for September. These are really low numbers. The one I had on was a 30-point wide diagonal spread. I had the 630, 615. I bought September, sold August. But right now, if you wanted to just, like, let's say we open at where we're at now, you could buy the 630 October and sell the 600 September for $9. That's a 30-point wide diagonal spread for less than $1,000, and half of your cost is baked into the short premium that falls off. So there are ways to get defined risk, positive gamma, positive delta if there is a sell-off, and you can double that capital and hedge in a big way. And even if we grind higher, it's not going to be the end of the world. With the ability, with a 30-point wide diagonal, you can roll that into a 20-point wide or even a 10-point wide and reduce your risk dramatically, because you're starting off with a 30-point wide for less than a third of that width. And
the chart looks good. It's just I just hate being long stocks in August and September.
Yeah.
Unfortunately,
the click and drag where you can change the axis, it doesn't really work to the downside. It only works to the upside, where it gives you some more room. The other trade that has been a really good trade this year has just been like broke wing butterflies. So I've been using those in gold futures. So to Ilya's point, like let's say we're seeing a 50-point rally. Let's say you get another one tomorrow. you could throw on a call broke wing butterfly in SPX way further out of the money and collect $200 or $300. And if we do get the sell off, you can turn that into a symmetrical butterfly and keep that credit or a majority of it. I've been doing that with gold futures this whole year, and it's been a really good trade. So that's another alternative. Like, get a little directional, but still collect a credit, have no risk to the downside. It doesn't have the same teeth as a diagonal spread or even just like a short contract would if you're using like a micro futures contract. But there's plenty of ways to play this if you want to throw on some new neutral to bearish trades.
Okay, so broken wing butterfly is a little bit more of an advanced options strategy here. You're not going to have strikes that are equidistant from the midpoint. Do you mind just breaking down why, under what situation someone would want to put on that broken wing butterfly and how they would actually apply it? And I know, for what it's worth for the people here, you can go to tastylive.com and look up our concept strategies. This is in there. But Mike, while we have you, could you take out your whiteboard, so to speak, and explain it?
Yeah. So if you're in the GCV contract, the 23-day contract, and you pull up that options trade. So basically, the one I have on is buying one of the 3480 calls on the upside.
3480. Mm-hmm.
Selling two of the 3500s. And then buying one of the 3540s. And just move the put on the they're all calls. Sorry.
Oh, sorry, they're all calls.
Yeah, they're all calls. You can just drag them over. So yeah, so this, and then if you double click the middle one and then just add a contract.
Yeah, my fat fingering this.
Yeah, if you click the quantity button to the right.
Yep. Well, I'm just totally losing this. Anyway, go on while I figure this out.
So that'll right now it's a $220 credit. Is what I'm seeing. So basically,
making an arse out of myself here.
You're good.
Go ahead, keep explaining.
If you highlight the middle one, and then on the toolbar right above the price, if you click the right arrow where it says quantity.
I know. I it's right there. Thank you.
There you go. So now if you go to the trade mode and go to curve, and then click analysis.
There.
And then go to expiration or P&L expiration. Make sure that's highlighted. It's on the left side. Yeah, you're there. Yeah, click that again. So if you zoom in, you'll see what this trade is like. So basically, you're collecting $230 or whatever the mid price is. So you have no risk to the downside. But you have this upside kicker if we do drift higher near expiration. But the nice thing about this trade is, because I'm collecting $200 and change, if gold futures sell off, like let's say from 3,400 to 3,350, I can move that 3,540. So ultimately what I have here is a 20-point wide debit spread financed by a 40-point wide credit spread on the upside. So if gold sells off, I can move the 3540 call. So I can sell out of that call and then buy the 3520. And if I can make that adjustment for less than $250, I'm basically legging into a free butterfly and I keep the credit. So I've done this like 6 or 7 times where I'll get into it for $300 or $400 and then I'll remove the risk for $1 or $1.50. So I'm leaving myself with a symmetrical butterfly that I have no risk in. And then now if you make that adjustment, if gold actually does rip higher towards the butterfly, you can sell out of it for an additional credit. So lots to take in there, but basically playing for omnidirectional moves, removing risk to the downside. And then if you get a downside move, you can remove the risk from the spread entirely and create a symmetrical butterfly.
And we've lost Chris's audio.
I keep muted. I'm responding to something from our PR team. I'm doing a bunch of things here. It's like there's a show going on, right? So we have, Mike, I think it's really important because I've talked about this a few times this week on air. A lot of our audience, a lot of traders have 3 years, maybe even less experience before they even get to options. And just retail traders in general don't have that much. So when we say something like a broken wing butterfly, it's, I don't even trade like this. I don't think this is necessarily the way that I have succeeded.
Not the way I do it.
But having
And
you on here,
not because I have, by the way, a strong opinion on this being right or wrong. This is just not the kind of approach that I grew up doing. So I'm learning along with everybody else in strategies like this.
and that's, I think it's an important thing. There are many ways to skin a cat. And if you're a SpotFX trader, maybe go to currency futures. If you trade currency futures, take a look at SpotFX. Do something what Mike's talking about. Because I have not been great on gold. Ilya, you have. I'm still leaning long deltas, but the way that I'm doing it is through calls. You've been doing it through short puts. I know right now you're not necessarily long gold.
No, I'm short calls now, but I'm still on the sort of vol extraction side of it.
So, Mike, to that point, it's an 18.3 IVR. Silver volatility is also likewise deeply in the hole here, 6.7 IVR. How do you approach? Do you have a specific approach for a volatility regime in the metals, or do you like looking at GDX and GDXJ, which these guys are looking a little bit different than gold and silver, which have been kind of stuck in the mud?
Yeah, I think for gold futures, just because it's a bigger product, I'm almost always doing defined risk spreads like that. But if volatility picks up, I would go to GLD, GDXJ, depending on the size of the product I want to trade. But GLD, I've been doing a lot of straight up diagonal spreads there. So because like right now, same story, 15% implied volatility is so low. Like the delta you can get in here relative to a $310 stock is crazy. Like these products, in any product that has less than 20% IV, is so low implied volatility. Like yes, you can have a move that's within there, but it's just so narrow, and you're usually going to get some kind of thing in the real world that moves that product greater than the implied volatility at some point in time. But yeah, if we were to get a big pop in GLD implied volatility or GDXJ, that's where I would go to sell premium, just because they're smaller products. But yeah, right now I'm just sticking with the gold futures, straight up broken butterflies, and just keeping risk really small and giving myself a lot of ways to have that thing work out.
Oil here today. Volatility is trending a little bit lower here over the past few sessions. It's 28.2 IVR. Ilya, it's still sitting around 64, 65. We're shuffling back in. There was the announcement today from President Trump that he'll be meeting with President Putin to talk about ending the Russia-Ukraine war. So I think this August 8th deadline is, just more theater. How do you feel about oil at these levels? Are you still trading this sideways like I am?
I do not have anything on in oil now. Basically, the last thing I did in oil was being short that spike back in June and fading that down. Since then, we haven't really gone anywhere. And again, horizontal line fans rejoice. If you put a horizontal line here basically through like 62, 61, you get a very clean axis where you had a consolidation range after the April shenanigans. You take that out in June, you spike, we've come back, we're retesting the same axis. So we're essentially sitting at the midpoint of this, call it 62 to 72, 74 range. And this thing's got to make up its mind. It doesn't look like there's anything terribly attractive here. There's a little bit more IV, so I suppose you could entertain some downside to upside balance and attempt to kind of extract this. But for me, my bias is bearish because I think growth concerns ultimately overwhelm everything else, and energy is very cyclical. But it hasn't happened yet, and the price action isn't saying that it's about to happen. We're basically sitting at the bottom of the range, and so the risk reward is collectively terrible. If you're going to be directional, then it doesn't make sense to sell directly into the bottom of a range. Nothing says that it's not going to hold here. At the same time, the long side is unattractive because nothing says that you will. You're basically just scraping that, and there's no sign that you're turning. If ever that there was any reason to be skeptical of the downside, is OPEC Plus came out and said that they're going to increase output, which almost certainly is a thing to fade. So, because these guys are incompetent and they can't do anything. So, if you look at this and say, right, so they're saying that at face value, the bias for prices is lower, that's almost certainly wrong, just because of the nature of OPEC Plus incompetence. Maybe you look to fade it, but there's no evidence suggesting that you should. So I'm standing on the sidelines here. I want to be short, but for reasons that haven't materialized in the price action, and the risk reward doesn't suggest that this is a time to put your leg in the water and feel things out.
Mike, I've been leaning directionally neutral for the better part of the last 6 weeks now, just continuing to push on to short iron condors. How do you feel about oil here? There's part of me that sees an uptrend breaking, which says maybe lean a little bit more directionally neutral, bearish. There's another part of me that says we've just been meandering around 64 for better or for worse. March, April, May, June. Why not August?
Yeah, I have to admit my leg is deep in the shark and piranha infested waters here. I just got long the micro crude contract today, but I have more of a Neanderthal view. It's just like 5 red bars, then I will buy. Yeah, but
yeah, I mean, hey,
I mean this is a product.
Anything else?
Yeah, this product is. I only do one contract, so this product is relatively small. I have been doing iron condors in the bigger crude contract, but just looking at this, like if we bounce from 64 to 65 or 66, they'll just take it off. I'm not looking for a huge move, but I'm willing to hold the risk going forward. And just doing one contract, keeping the size small, even if we get a move to April lows, it's not the end of the world. But I'm willing to take a stab at this regardless of the narrative, just because you can get small with the crude contract and see what happens. But yeah, bigger intraday range today. We'll see what happens. But yeah, I just bought the contract a little bit earlier today. I got filled at 64.60 or something like that. So I'm looking for a little bit of a move higher.
Yeah, a little bit of a move higher. We had some inventory today, and we still have severely low inventories here in the U.S. That's the story. Now, inventories are being rebuilt. What does that mean for the economy? I mean, we point to the research that shows if you look at the last 30 years of data on a rolling quarterly basis, demand for crude oil measured against global GDP has a correlation of about 0.92, nearly perfectly positive. And we have lots of evidence that growth is slowing, so probably not good for crude. That said, we don't want, I say we collectively, but the administration doesn't want oil patches going under. They don't want American production to shutter in. So does oil get that far below 60, 55? Probably not. Mike, if I was short this, I would not get that much more bearish when I start seeing a 5-figure. And if it's a 5-figure, I start looking long. And if we start dipping below 56, then we have much bigger problems on our hands that probably are spilling over to the equity market. Yeah. So I'm comfortable just looking for more ping pong around here. Goes back to 65, 66, staying directionally neutral. There's a lot of time, 42 days still. Slow burner, but that's what theta decay plays are. We just have to run out the clock. and hope things don't change too much.
Indeed.
It is Wednesday, though. Before we go into anything else, you guys planning on watching anything fun tonight, Mike? Anything on TV around 10 o'clock?
I don't.
You don't have Paramount Plus, do you?
I don't. What am I missing?
What's going on here?
There's a new South Park episode tonight.
I'm sure it'll be the number one most watched episode ever after the last one.
No, nothing's going to beat Scott Tenorman. That's just too good. That's too good. Scott Tenorman's chili is too good. Nothing will top that.
I did watch Hard Knocks last night, though. That was great.
Oh yeah. Who are they? The Bills?
The Bills, yeah.
How is New York's only football team?
They're great. They're going to be great. It's a good look at Josh Allen, how he's just a regular nice guy. But there's some very entertaining scenes in it. Got to check it out.
Yeah, the New Jersey teams. We don't talk about them. We don't talk about them right here. Yeah, and you know what's so funny? James Coney, one of the producers, he always throws Jets jabs at me. It's like it's been like half my lifetime since they made the playoffs. I know they're bad. This is like a gotcha.
When I saw the Justin Fields headline of him getting like carted off, I was like, "You got to be kidding me with this team." But it was minor.
That was very much expected. Okay, so speaking of media here, Disney had earnings today, Mike. The stock trades a little bit weaker, 2.66% to the downside. McDonald's, Disney, Uber, Shopify, these seem like pretty standard American consumer-facing products. I know that Shopify is a Canadian company here, so it's a mixed bag. What's the most compelling earnings story that's going on right now? Is it how companies that are not meeting the mark are getting punished? Is it the fact that the market's still holding up? Do you have any compelling earning plays coming down the pipeline?
I mean, we're kind of running out of earnings trades going forward. There are still a few that are yet to report that are big names. I think it's Netflix or Nvidia, one of those two.
Netflix. Nvidia is coming up in what, the 27th of August? Yeah. August 27th.
Yeah. So Nvidia is a later one, but I traded DraftKings to the downside today, just because I'm not loving all the tax stuff I'm hearing flying around of like how professional gamblers can't write off their losses if they're doing different books. That would apply to like professional poker players and sports bettors, things like that.
Can you explain that a little bit more? I haven't heard that. That's interesting.
It's basically a new or an amended rule where you can only write off 90% of your losses against gains from a different book. So like, let's say your net profit is $10,000, but you're doing it on big volume and you've done $200,000 of revenue and you have $190,000 of losses, you can only write off 90% of that $190,000 loss. So there could be a scenario where you don't make any money, you scratch, but you're paying the government as if you won because you can't write off everything. It's crazy. I don't know if it's going to completely go through, but there's a lot of professional poker players I follow that were going nuts at the implications of that. Obviously, because if you're playing big tournaments, those are $10,000 a pop. So
interesting. Okay, that actually makes a lot of sense because my mom's a tax attorney. My brother's in sports gambling, and last time they were together, I heard him complaining about something to her with taxes. Now this all
that's what it was.
It's all coming together.
There it is.
Now it makes a lot of sense. Okay, it's like, well, hey, it sounds like it's they're trying to disincentivize people from sports gambling then.
It would appear so. But there's always a workaround. Like if you just stick with DraftKings, it's not going to really matter because it's all centralized.
Right.
But yeah, DraftKings rallied after the close. They're selling off closer to the close price. I played it to the downside with a long-term diagonal spread. But yeah, I mean, I think Disney's interesting because Disney is acquiring, ESPN was acquiring Red Zone and that whole product suite.
They better not screw that up.
Yeah. I'm not sure that they will. I think they'll be okay. But
you think they're going to put commercials in there?
Maybe. Maybe. I mean, Netflix is interesting. Netflix has just sold off aggressively from the highs. There's been talks that UFC might catch a deal with Netflix, but all these streaming companies, like eventually, they're going to be the main stakeholders in all of the MLB, NFL, UFC products that we love to watch. So we'll see who comes out on top there. But yeah, I think Nvidia will certainly be kind of the fireworks to end this earnings season. But we've been looking at trading some fringe products. AMD, sizable move to the downside, kind of surprising. But then again, all these stocks are up 100% from April lows. So what are you going to do?
Yeah, that is something I shared in our research chat internally here today, taking a look at how the rally has evolved. Goldman Sachs sent out this report. S&P 500 from the Liberation Day market lows. S&P is up 27%. Nasdaq's up 38%. Unprofitable tech is up 57%. AI-related names 60%. Their basket of most shorted names up 68%. Their basket of meme stocks 77%. Quantum computing stocks are 84% off the low from Liberation Day. This is a very funny inclusion. ARK, Cathie Wood Fund, is up 86%. And then Bitcoin-sensitive companies are up 112%. So their title of this note is High Momentum and Lower Quality Groups Rallied the Most Following the Liberation Day Market Lows. This is the returns from 4/8 through 7/31/25.
Asterisks in dollar terms.
Okay, but even accounting for the dollar loss, you have how much is the dollar up from April 8th? It's basically flat, in fact, right?
The dollar is not up.
Since April 8th?
Oh, since April 8th, the dollar has really only started what is starting to look like a little bit of a rebound on July 1st.
Okay, so the dollar's 4% lower, and if we back out the dollar, ARK is up 82%. Okay, it's still crazy.
It's still crazy, yes. But I mean, obviously, we're talking about very different volatility. When we compare the dollar to something, the thing that it makes sense to compare it to is the S&P, the NASDAQ, because these are now comparable-ish things volatility-wise. I mean, obviously, these things are not remotely as liquid as the dollar, and so you do have to scale it. The low quality of the names tells you a story. Yeah, they're up, high risk, high reward. But at the index level, what you see as positive sentiment in U.S. equity markets since April, then extrapolated over sort of the range of volatilities and jumpiness across markets, what you end up with is, at the index level, the dollar has fallen a lot more than stocks have gone up, almost by half. The S&P is up, about 6% on the year? In fact, stock markets in general, on average, Russell, NASDAQ, S&P, on average, up about 6% this year on net. Dollar's down 13.
Like if things like ARK are flying, I think ARK is pretty funny. Years ago I was actually called up by the New York Times to help contribute for a profile on Cathie Wood, which I don't know her at all. Never met the woman. I'm sure she's delightful in person. But they were asking about her investing strategy, and I pointed out I was asked, "Do you think that she will change her approach?" And I said, no. If you listen to her and you read everything that she's written from when she founded her firm, her investing strategy is informed by her faith. Everything she does is informed by her Christianity. And so I said, I don't think Cathie Wood is ever going to give this up, because unless she leaves the religion, right? And she has stuck to it. So credit to her. That's the power of faith, I suppose. Mm-hmm. She has And this was what the whole profile was. Seriously, like, look it up. It was a New York Times article from like August 21, where they looked her up and talked about her, a success. And that, of course, is a few months before the bubble begins to pop. NASDAQ peaks in November 21, S&P in January 22, and then ARK goes by the wayside for many years. In fact, just to make that point emphatic on the chart, we'll go to the weekly. Right. So this is basically when she's profiled by the New York Times. Things have changed since then, is my point. But what do you make of a market, Mike? Because Ellie and I talk about this every day. This guy kept me up on the phone for 3 hours last night until 1:30 in the morning. So I've heard enough of him. What does it say to you that these unprofitable names, the AI names, the meme stocks, the Bitcoin, the ARKs of the world, are the ones that are leading to the upside, outpacing your regular S&P 500?
Well, to me, it tells me that there's a larger appetite for risk overall in the market. I think that parlays directly into what we're seeing in the real world, like sports book stuff. Like you watch a Mets games now, you're gonna see DraftKings, FanDuel, all the casino stuff. Like unless you're in a area where that's illegal, but.
We're not watching Mets games these days, Mike, because the team is so bad.
Yes. But yeah, I mean, I think I think a lot of people look at what's happening right now, the AI movement and how things are changing, and they think to themselves, this could be the next Apple, this could be the next Microsoft. Let's get in now before it's too late type thing, regardless of the outcome. So, and when you think of the cost of everything, I actually read an article. I think the Stock Messiah in the YouTube chat sent me this article, if I'm not mistaken. But it was basically how everybody's like, my world doesn't change if I lose a couple $100. Why not throw a couple $100 into something that could 10x or 20x? Like that's the mentality that a lot of people have. So I think it's an appetite for risk. I think it's people want to be involved and not on the sidelines. We're seeing that with options volume uptick. We're seeing that with more people with brokerage accounts. It's never been easier in the last 10, 20 years to open a brokerage account. You can open one in 5-10 minutes. So I think it all just kind of, everything goes hand in hand, and more people want to be in it than just watching on the sidelines. So that's kind of my take, but it's always interesting when you see mass participation and then how people react and how markets move when more people are reacting in the same way. And I think that's why you're getting a lot more of these violent sell-offs followed by violent dip buys. Everything just moves so much more quickly than it did 5 years ago.
Which is interesting because obviously vol readings are relatively low. So you have this thing where the market it's almost talking out of both sides of its mouth, right? Where you get these, just look at currencies, which were dead for years, and look at these swings now. I mean, this is easily the most deep pool of liquidity anywhere, and now you're seeing major currencies swing like they're emerging market exchange rates. So on one hand, the swings are wild, even in very liquid names, even in very liquid tickers. On the other hand, you look at the VIX across the board, and it's not just VIX; it's crude oil volatility, it's the MOVE index, which is bond market vol. You look at all of this stuff, and people just don't see or price it. And it feels like complacency to me, but until it is, it isn't. So it hasn't cracked yet, but Mike, to your point on sort of risk appetite, if I have $200 or whatever to roll the dice on an asymmetric outcome, that's kind of how I feel about the baby short exposure I have in the stock indexes here. If you lose very little. I've locked in on my verticals somewhere in the realm of 1 to 1.5% of equity risk on each one of these positions. It's nothing. But if they work, they really work.
If they work, they really work. But they're not working for me, Elliot, right now.
Not yet.
One thing that I wanted to pull up here as we close this out is something that really ground my gears today. And we have been taking a fair amount of shots at the President of the United States and some of his ridiculous policies. So we have to, in good faith, call out bad things wherever we see them here on Overtime, because we stand for intellectual integrity. Bernie, no! Why on earth are you publishing a chart of median home prices versus real weekly wages? That makes absolutely no sense. What a chart crime of chart crimes for the century. This is horribly misleading, even if the underlying point stands. You can head over to Fred and remake this chart yourself. And what I did is I anchored real wages to 2010 levels. I anchored real median home values to 2010 levels. The dark blue line is your personal income. The dotted green line, that is your home value. What do we see? Yeah, home value growth price growth has absolutely outpaced wage growth since 2010, since the global financial crisis. But you know what? This chart doesn't prove that point. So
no, it doesn't.
Stop doing things like this. As a home building max, as a homeless, okay, this hurts the conversation. So shame on you, Bernie Sanders. Shame on you. With that, Overtime's out of time. We'll be back tomorrow, same time, same place. Every Monday through Thursday, 4 p.m. Eastern, 3 Central, right after last call. So for Ilya Spivak in San Francisco, Mike Butler in Chicago, I've been Chris Vecchio in New York. Good luck trading. More Tasty Live next with Ilya and Macro Money.
Well, stock markets decide that they're going to continue to idle. We get a pullback yesterday. We erase that pullback today, ultimately end up essentially where we closed on Monday. Markets attempting to find a path of least resistance, apparently. But a more interesting thing is seeming to be happening in currencies. US dollar taking another bash on the head today. And that's setting up an interesting opportunity, perhaps, for investors waiting for stock markets to do something and waiting for bond markets to do something. As we get a little bit of a contest here between global central banks and who will cut interest rates when. Because while the Fed is still dithering, we're going to have a Bank of England monetary policy announcement here that is almost certainly going to give us another cut. And so what this sets up then is a little bit of an interesting dynamic as we look at what is likely to happen next in, at the very least, the currency markets, while stocks try to find their way. So, what we're going to do here on Macro Money, I'm Ilya Spivak, head of Global Macro here at Tasty Live, is we're going to break down what is happening here, what the Bank of England is expected to do, and then land on what the trading opportunity here seems to be, because this does look like something of a juicy setup. So, this is the expected outcome here. We can see for August, we're expected to have rates come in from 4.25% to 4%. Looking at benchmark SONIA futures here, these are the UK equivalents of Fed funds futures for the Fed in the US. We have the cut fully discounted. It's there. It's in the market. That's not going to surprise anyone. We also have another cut on the menu by year end. We can see by December we're at 375. So we're looking for this cut and then one more before year end. And if we look at the way that the overall outlook here has shaped up, it has been remarkably stable. And we see here that beyond the cut that at this point is something of a given over the next 24 hours. Here's that extra cut before year end. And then another one on the menu for next year. So the full 25 basis points of another cut now baked in, and the markets apparently assigning a slightly elevated chance, so a non-zero chance, if you will, that there will be a little bit more. But of course, at 32 basis points, it is in fact just a pittance. So if we consider sort of what we're looking at here, 32 basis points is only 7 in the direction of a second cut next year, a second 25 basis point cut, which puts the likelihood there at just 28%. So the market's seemingly well anchored here around one more cut this year beyond what the move will be over the next 24 hours, and then one more next year. Now, this has been very stable. We can see here going all the way back maybe to April, May. The tally has barely budged. We've kind of oscillated in this 50 to 75 basis point thing, so within one cut range, and we're not really going much of anywhere. And the reason that this is so interesting, of course, is because the dynamics around the UK economy would suggest that there's a very similar kind of stagflation flavored worry here as what has kept the Fed on the sidelines this year. So in the first quarter, we can see GDP growth in the UK slowed. It was rebuilding all of last year, and then starting this year for the first quarter, it took a step lower. Since then, this is now the first data that we have going into the second quarter, we can see that both April and May saw GDP decline. The UK is one of the few economies that publishes monthly GDP data, not just quarterly, so you get a sense for which way the wind is blowing, as it were. And we can see that into the second quarter, things do not look good. We have output actually shrinking. Moreover, if we take the year-on-year view of this monthly data, we can see that the situation has significantly deteriorated. The year-on-year growth rate took a little bit of a leg lower in April, but it really fell off the edge in May. And so we're looking at here the weakest economic growth dynamics for the UK as of May in just about a year. Reference point here is June of 2024. So the situation is looking soggy. The latest numbers that we got on the Purchasing Manager Index data that was finalized from S&P Global this week, initially published 2 weeks ago and finalized on Monday this week, or Tuesday, we're looking at signs that, again, we're kind of idling with a downward drift. In particular, in July, overall output took a leg lower. As ever, of course, these numbers are centered around 50, where that's neutral. Above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And we can see that while we're certainly not in contraction territory here, the July numbers are pointing us in the direction of a slight weakening here in overall growth. We tick down on this composite index. And so the growth dynamics over recent months and over the course of the second quarter going into mid-year, not great. But at the same time, the inflation picture is firming. So what we see here is in particular, an uptick in this housing, fuels, and utilities component, which is essentially energy prices. And what we find is that that's becoming an increasing uplift on overall inflation, so much so that in June, we end up with headline inflation at 3.6%, which is a 17-month high. Moreover, the core number, which takes out fuel and energy, ticked up even higher to 3.7%. That's not so crazy considering it's been running north of the overall here for a while. And to some extent, this reimagining of what's going on energy is statistical give back from what happened here, where energy was actually a negative influence on overall inflation. So in some sense, we're rebasing in this data. But that we haven't really moved on core tells us this is not just something you can easily dismiss as energy prices being a weirdness in the data. In fact, if we look at the breakdown here, to be sure, we have an outsized contribution from energy, and that's echoed in a pretty significant jump in transport costs in June versus May. But even if you hold that aside, the inflation picture is relatively elevated, and it's not difficult to make that determination. I mean, here's about 1%. Here is another one. So that's the 2% inflation target. And then on top of that, there is all of this and all of this, giving us inflation, even if we hold this aside, north of the target. So if we kind of back of the napkin eyeball this math, we're sitting at a headline rate of 3.6%, take away these shenanigans on fuel stats, and you're left about 1% lower, and so still going the wrong direction. And yet, just take a look at how tightly wound these implied rates curves are. We haven't really deviated from this implied rates path over the past two BOE meetings, despite the fact that the data has been a little bit confounding, in that, of course, much like what the Fed is worried about in the US, we have these stagflation-flavored dynamics. Now, we don't want to say stagflation is here, because obviously the economy isn't stagnating, but we do have a parallel rise in inflation with a slowdown in growth, which is precisely the kind of policy trap that the Fed is so concerned about, and why they haven't cut rates so far this year. And so, in some sense, this BOE situation is very interesting in terms of what it might mean and how that extends to what the Fed is doing and sort of what the logic here looks like. These policy expectations have been remarkably stable. Moreover, while the BOE is cutting while the Fed is holding, their latest cut, the one that they took this year from 4.5 down to this 4.25%, that only just caught them up with what the Fed did last year. So last year, if we remember, the Fed cut rates by 100 basis points between September and the end of the year. 50 basis points in September, another 25 basis points in November, another 25 basis points in December. The BOE started cutting sooner. They started cutting from 5.25 in July. And now down to 4.25, they've caught up with the Fed. In other words, they've now issued their own 100 basis points. They started earlier. They're still going. The Fed did everything in one shot, as it were, or over the course of just a few months. But the BOE has only just caught up. And this cut will be the first step to pace ahead of the Fed on easing. If we look at the outlook, though, the outlook still favors mainly a staid Bank of England. So as a cumulative tally beyond this cut, we're looking at about 2 more with some rounding error through the end of next year. Compare that with the outlook for the Fed, where, never mind what policy officials are saying, although even their outlook is more dovish, they're seeing 50 basis points this year, basically equivalent to what the remainder is for the BOE with this week's cut and then one more. But then the markets see 70 basis points next year, so they're veering on 3 cuts from the Fed next year for a cumulative 5 cuts between now and the end of 2026. That's against 2 more cuts. So that's 3 more cuts from the Fed than the BOE. And yet, evidence of economic weakness is much more acute in the UK, at least looking at the PMI data, than it is necessarily in the US, although, of course, the evidence does seem to be stacking up. Weaker jobs growth, obviously, the ISM numbers this week putting the economy in the US at standstill, the second quarter GDP number giving us such a weak consumption reading that in the first 6 months of this year, we end up with the weakest stretch of household consumption since the first 6 months of 2020, which was, of course, the COVID recession, and U.S. inflation is ticking up, albeit not as much as in the UK. So one would think these are somewhat analog situations. One would think the Bank of England is going to be a little bit more reticent, much as the Fed is being, because this does put them somewhat at odds. On the one hand, the weakening growth seems to indeed beckon cuts. On the other hand, the higher inflation seems to argue for patience, as the conundrum that the Fed has highlighted. But again, the delta between these curves is tiny. So from May, 2 meetings ago, to June, the previous meeting to the one this week, and now less than 24 hours before the next meeting, the policy path has barely changed. So the Fed was more dovish than the BOE last year, is looking to be more dovish than the BOE looking at market expectations through the end of next year. Policy appears to be on autopilot. And yet, and this is where the trade idea seems to emerge, the British pound has been at the forefront of a rebound in the US dollar. That is to say, the British pound was the first of the major currencies at the beginning of July to really start to roll over against the US dollar. A tariff deal between Prime Minister Starmer and Donald Trump, notwithstanding. The UK was out in front on a deal on tariffs, and that hasn't helped. As a matter of fact, what we have here is a very clear reflection of the dollar's blistering sell-off since the beginning of the year becoming overturned, and this series of higher highs and higher lows giving way to the dollar recovering and starting what appears to be a new sort of trend. Now, the dollar has taken a little bit of a beating here this week. We can see once we found support here anchored right around 132, we've bounced to retest the underside of the former range here that's held between roughly 133.80 and 138. So this consolidation thing now being retested from the underside and tellingly holding. So the same kind of backfill that we saw here, where right around 136 there is this range bottom. You can see it annotated by these highs and these. We get the initial break. We hold this support, bounce, retest this underside, then make a new low. The stair step seems to be continuing. We hit this support, bounce, and we are now retesting the underside of this level here. That, of course, makes for a very interesting opportunity, because if there is, in fact, a dollar rebound that's building despite the fact that rates are looking much more dovish in their outlook in the US than they are looking in the UK, and at least in the UK, things are very stable and the markets are not looking for the Bank of England to do anything untoward. They're pretty well anchored on what is going on. Then what's happening here is a dollar that is recovering despite the fact that the markets are convinced the interest rate differentials, the typical drivers of currency markets, are pointed against the dollar. And so what this then sets up is a very interesting situation. If the Bank of England were to deviate from consensus, that is to say, if, for example, we got the cut, but the guidance seemed to suggest that there's more easing on the menu than is already anticipated, then the British pound would likely fall, because there would be a readjustment here to a less favorable yield differential for it versus the dollar. And perhaps the slowing growth dynamics do that. If, on the other hand, the Bank of England issues the cut, again, that much is pretty much a foregone conclusion, but then expectations for further easing are actually diluted because it decides to focus on the inflation piece and say, well, you know what, 3.6% is going in the wrong direction. We're probably going to see more in this sense. We don't want to let inflationary pressure out of the bag. Let's make sure that things remain anchored. Well, then maybe you get a little bit more British pound strength, but it hasn't been able to make hay of the yield differential so far, so it's unclear that it's going to be able to do that. And then let's suppose that the market is right in that it's been so stable in what the BOE is expected to do, and it basically has concluded that the central bank is on autopilot, that it's going to do what it's doing, look through volatility in near-term data, and say, you know what, we're just going to keep doing it. We're just going to keep doing what we're doing. Well, if the market is right on that front, then the status quo remains. And that status quo is a British pound that is retreating despite the interest rate differential story seeming to favor it. And when any asset is unresponsive and indeed moving in the opposite direction of what the sort of macro, fundamental, whatever architecture seems to imply, when the price action is openly clashing with quote unquote the news, well, then you have a market that has a very strong intent to go where it wants to go. And that's something of a tell. In that context, then, what we've seen in this British pound rebound over the past 4 or 5 days is an attractive mulligan, whereby if you haven't entered short already, this becomes the next opportunity to do so. Obviously, doing so directly in front of event risk is not the world's greatest idea. But if you get any level of spiking, any level of volatility around this zone right here, and you end up holding here rather than breaking out, then what you end up with is an attractive setup. Now, you might front run that and say, well, you know what, we're already back testing here, and if one is wrong, then one is wrong quickly, and if one is right, then we have an extrapolated move down implied here. If we kind of, again, back of the envelope, extrapolate what this topping setup would mean going forward, and sort of the first page of a technical analysis textbook answer to how you do that is you take the height of this range and you plot it down this way and say, okay, well, if you basically move the width of the range down, what would that look like on a confirmed break? And that looks like a return down to sub 130, around 129.60 or so. So this appears asymmetric in favor of shorts, and the price action seems to suggest that the risk reward is attractive at these levels, and the way that the pound has been behaving suggests that it has a mind to go lower, even if the news and the interest rate architecture seems to suggest that it should be doing the other thing. And that is Macro Money for today. As ever, we are here after overtime, Monday through Thursday. That's a show I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and where things may go therefrom. I'm likewise on with Chris for Futures Power Hour, Monday and Friday. I'll be on for a special one tomorrow, so come and join for that. I'm also on with Chris and Tom for First Call on Sundays, writing for the news and insights portion of tastylive.com, and commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.
Stock, shake it off. It's Wednesday. It's August 6th, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, Mike Butler in studio today, sitting in for Dylan Radigan. He's in Chicago. We're here to take you through the rest of this hour as we wrap up the trading day. Futures market closes at 5 Eastern, 4 Central. As always, you can follow us on the platform Tasty Trade on the website tastylive.com. Come over to YouTube. Mike's manning the chat. Tell us what you think of this action. What do you think of that bond market flash move lower this morning? Not sure what that was about, although there was a pretty terrible 10-year note auction later in the day. Doesn't matter to stocks. S&P 500 up by 1.2% and change. S&P 500 scaling the wall of worry itself. Not sure if it's an impressive day for the broader market because the breadth is pretty bad. Russell lagging the pack, most sector ETFs underwater. Instead, our attention turns to Ilya's beloved US dollar, which is punching both him and I in the face.
Yes, it is.
Gold, silver are perking up a little bit here. Obviously, lots of corporate intrigue with earnings out over the past 24 hours. But Mike, we'll start with you because you're our returning champ here to Overtime in the guest spot. We have a market here that's quite resilient. S&P 500, 63.71 on our screen. What say you about this market moving up as we make our way through this first week of August?
Sometimes you just got to close your eyes and smile and just buy every dip you see. I don't think I've seen Tony so happily bullish before. It's very, very rare from last call. But yeah, I mean, when we had the initial sell-off last week, the first thing I did was look at volatility futures, and they were basically not moving. They were up a point, which is basically, for me, that's nothing. If we were to have seen that sell-off and maybe 3 or 4 points be infused into vol futures with maybe a little flattening of the curve, I think that's more telling of a continuation there. But now we're seeing the dip bought in every avenue. Like Apple's was up $10, $11, $12 today. Amazon up almost $10, just reversing the woes of the earnings results from last week. So the market is telling us we should see certain things, and we're seeing it. And so I guess it's that. I guess that's the environment we're in. feel like we've been there for the whole year.
Dylan's not here, but I think we're recreating him in the aggregate, Ilya, from yesterday.
It does seem like it, doesn't it?
Yeah, Mike, I don't know if you saw Dylan's rant yesterday. He berated Ilya and all bears. Even as a fellow bull, it's like, please stop. He's already dead. But Tony's pretty bullish, and you're bullish. So, Ilya, we don't have
and
a Dylan
I'm unrepentant.
Today, and you're still sitting. Okay, so why is Mike wrong?
I mean, just take a look at the chart of the S&P and tell me what has actually happened. But
it's like a Rorschach test, Mike.
I mean, let's just put a horizontal line through 6,400 on the S&P, and you tell me what has happened. But it's not exactly rocket science. Last week, we pushed a range. We broke through that range. We remain under that range. We have gone absolutely nowhere but for about a 50% rebound off the lows on Monday. Yesterday, we went a little down. Today, we went a little up. It's a new range we're carving out, and we're consolidating. In other words, the markets are net down off the high, and we're waiting for them to see if they're going to attempt to make a run at offsetting or invalidating that breakdown, or if after what is a textbook retracement after a big move, we're just digesting before the next decline. Have we broken the series of higher highs and higher lows going back to the latest swing bottom in late June? Yep. Have we undone that break? Nope. So what exactly about this price action today tells you anything has changed between the end of the day on Monday and now? Nothing. Zero.
All right.
Oh yeah, I'm a little pissed at you. It feels like you're like, come buy some puts, we'll have a laugh.
The water's fine. The water's fine.
And if I was just amoral and mindless like Dylan said we needed to be several weeks ago, things would be going a little bit better. I kid, of course. I mean, not really. It's not like I sold at the low, so I'm not really feeling the pain. But there's a resiliency to this market. I mean, the Apple news today, Mike.
Again, is there? We're down from the high last week. We haven't come back to retest that high. Where is this resilience? Because the market is
Apple's
up a day.
Apple's up, Ilya. Apple's never up.
At the top of the range where it's been stuck since early April. Again, where? What is this resilience that we're talking about? Where is it? Show me.
So, Mike, this is my quip with today's market, and I want to give the devil his due, although Ilya's, well, we'll leave that up to the audience. But 10 of the 25 sector ETFs are in the green today. That means 15 are red. And I couldn't help but notice in today's session, when we look at something like SPY, for example, it's up by 0.75%. Our RSP, the equal weighted in S&P 500, is down by 0.2. Same thing for the triple Qs, up 1.26, QQEW only up by 0.49. So that doesn't really seem like a healthy market, so to speak, kind of fake looking at the top level. Does that concern you that there's not a lot of participation with today's rebound?
Yeah, I mean, I think it's always cautionary when you have a couple of names driving what feels like the entire move. And of course, under the hood, there's definitely some issues. I mean, looking at the Fed Watch tool, this completely flipped. This is totally inverted from what we saw a couple weeks ago, where we weren't projecting cuts, and then one day everything flipped. Now we have a 95% chance we get a 25 basis point cut. But I stand by, prove it to me, do the cut, actually do it. But we'll see. Maybe the market is kind of timid until we actually see the cut happen. Strong possibility that it's going to, but this year and last year, it's just been kicking the can down the road. So I think if we do get the cut, I think that's when you may see a lot more volatility in all these names that are in these indices, and maybe that's when we get the macro move that we're looking for. Where right now it's kind of just this low vol chop, but that would be a little depressing because we're over a month away from the next decision.
One thing I think, I was doing this as I was getting ready for the Bank of England rate decision overnight, but it's important to remember the Fed cut rates by 100 basis points last year.
What's your process for getting ready for the Bank of England? Do you like brush your teeth, haircut?
That's later. Here I'm just updating charts, looking at what's priced in, getting my pound shorts ready. But as I look at this, they're widely expected to cut. And of course, the president is going to crow about it like he did the last ECB cut. This cut for the Bank of England will be the first one that actually gets them a hair ahead of where the Fed has been since December. The Bank of England has been cutting longer than the Fed, but the Fed has cut more. Last year, the Fed cut by 100 basis points. We should be starting to see that begin to filter into the economy right about now. And the second quarter GDP numbers gave us the weakest 6 months of consumption this year since the first 6 months of 2020, the COVID recession. So the macro situation in the US looks pretty awful if you kind of consider things in context. The jobs report, awful. The ISM numbers, awful. The consumption numbers, awful. Inflation, back up. The reason the Bank of England is so interesting is they're in a similar boat. Inflation is up, growth is cooling. Only now will they take a step in the direction of outpacing the Fed by 25 basis points, but they're only baked in for this cut and one more this year and the third next, which is way less dovish than what's on the menu for the Fed this year and next together. So you look at this and you go, okay, well, should the Fed be cutting? Markets think so. But it's not like they haven't been, and it's not like we shouldn't be seeing that stimulus. And yet it's not here. So what does that say about the underlying economy? And is it actually weaker than meets the eye because the stimulus is starting to have an effect to some extent?
How much per year will the tariffs cost you as consumers? Do we have an estimate for that?
I think we're going to find out, because the tariffs are such a black box at this point. I mean, obviously, we're waiting for this cliffhanger this week. Maybe we get another thing that happens. Maybe there's another announcement. Today, India caught a 50% tariff. So we'll see. I think the essence of why the Fed is dithering is nobody knows.
In the United States, there are 128.7 million households. That's according to latest census data as of end of 2023. The Yale Budget Lab is projecting that the median American consumer household, family of four, is going to see about $2,080 in charges. So we're talking about a $250 billion hit to the economy. That's considerable. You know, one of the reasons why lower rates may not...
numbers make sense.
I mean, that may be one of the reasons why we haven't seen the interest rates flow through, because interest rates would be helping, say, small business formation. But if you're a small business right now and you only have one supplier and you don't have the ability to stock inventory because you don't have the facility, because you don't have the balance sheet, you're just screwed. It doesn't matter if lower rates are coming around the corner. You can't operate in this environment. So maybe the lower rates just they don't make a difference this time. But there are encouraging signs, right? I know this is a lot of idiosyncratic related risk today because telecoms are surging to a new all-time high. Consumer discretionary is on the up and up here. Mike, these aren't exactly hallmarks of a bear market. When the tech names, when the consumption names, when XLK, this is a new all-time high close this week if we were to close at these levels. How are you managing to ignore the noise, ignore this? Maybe you ignore seasonality all the time, but how are you staying on for the ride right now? Because I found that to be very difficult. And quite frankly, I haven't been involved since Thursday.
I am trading live cattle futures.
That's what you got to do. Man,
Yeah.
I've been sleeping.
Yeah.
That's what you got to do.
I mean, I've definitely increased my exposure to futures products. So I have wheat position, corn position, micro natty gas, micro crude, live cattle, and gold. And that makes up like half of this portfolio. The rest is just sizing down, doing more diagonal spreads, calendar spreads, some iron condors here and there. But yeah, I don't think anything really changes. I'm more prone to taking risk off with smaller winners, especially if they're to the upside. Like Apple, I had a call diagonal spread, got bailed out today, took that off. Amazon, if we see another day like today, that'll be a bailout too. So I'm just basically shifting slightly and by way of taking off winners if they're smaller winners and I get them quickly, and adding more neutral to bearish positions in SPY and SPX. So I had a put diagonal spread that I put on in SPY, took that off when we got that 100-point sell-off last week. That was like a $200 winner there. And I still have an SPX iron condor on. That is, I have my short call spread at 6,300, 6,310. So I'm still leaning short with some positions. But yeah, I think keeping risk small, keeping cash on the sidelines, and really just being patient enough. Luckily, football's around the corner too. That'll give us something else to look at. But you just have to be patient and wait for this thing that's going to happen. Because if you're not, I think it makes sense to be positioned for a grind higher up and to the right until volatility picks up. Because there's just no way that the market sells off 5-10% if we're still in the teens in volatility. It's just not going to happen. So
yeah, I mean, Elliot, it's low volume, it's low vol. If the markets are, I mean, you and I went through this exercise, and for the sake of intellectual, which one of these notes is it on my desk? Not you, it's you. Monday, NASDAQ, you had 23,300. You pointed out 23,365 as a line in the sand. Russell was 2210, and the S&P was 6365 on Futures Power Hour. I see markets that are basically on this. All three of them are on the other side of those levels. So what are we actually hanging on here for? If we're trying to be a little bit more conservative, why not switch to directionally neutral as opposed to being outright bearish?
Because the vol isn't juicy enough. To Mike's point, you go directionally neutral, and what are you actually doing? The IV rankings here are not really giving you much to extract. So in my mind, again, you had a sell-off last week. That sell-off has not been invalidated. We have seen a little correction in that sell-off that is textbook in line with what you would expect, where we came back to scrape the underside of the range that was broken. It's the first page of any textbook on technical analysis, but never mind technical analysis. Let's not get that complicated. You had a range. That range was broken. The underlying assumption there is, oh, okay, something different is going on. Have the markets shown you that something different again is now occurring? No, they haven't. So what is it that you're doing here? Well, from a risk-reward perspective, you have a ton more room on the downside than on the upside. If last week's topping signal is wrong, and maybe it's wrong, I'm not married to it being right. If it's wrong, you're wrong fast. If you're right, you're asymmetrically right by a lot. Vol is cheap. puts are cheap. Duration is cheap. The thing to do from a risk-reward perspective, it seems to be the most obvious thing in the world, is to be a little bit short and see, because you can buy put verticals here that are risk defined for not even peanuts. And you can give yourself tons of duration to dilute your sensitivity to near-term delta and make this very easy to float. So if you're going to do anything, you have to be risk-reward minded and price action minded. Forget whatever you or I or anybody else thinks about the economy, the tariffs, blah, 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 blah. What's the price action say? We had a breakdown that isn't invalidated. Vol is cheap. Risk reward is asymmetric. This is not rocket science, as far as I'm concerned.
Yeah, to Ilya's point, the put diagonal I had on in SPY. So SPY IV rank low, implied volatility in 17.8 for September. These are really low numbers. The one I had on was a 30-point wide diagonal spread. I had the 630, 615. I bought September, sold August. But right now, if you wanted to just, like, let's say we open at where we're at now, you could buy the 630 October and sell the 600 September for $9. That's a 30-point wide diagonal spread for less than $1,000, and half of your cost is baked into the short premium that falls off. So there are ways to get defined risk, positive gamma, positive delta if there is a sell-off, and you can double that capital and hedge in a big way. And even if we grind higher, it's not going to be the end of the world. With the ability, with a 30-point wide diagonal, you can roll that into a 20-point wide or even a 10-point wide and reduce your risk dramatically, because you're starting off with a 30-point wide for less than a third of that width. And
the chart looks good. It's just I just hate being long stocks in August and September.
Yeah.
It's never worked out for me.
Unfortunately, the click and drag where you can change the axis, it doesn't really work to the downside. It only works to the upside, where it gives you some more room. The other trade that has been a really good trade this year has just been like broken wing butterflies. So I've been using those in gold futures. So to Ilya's point, like let's say we're seeing a 50-point rally. Let's say you get another one tomorrow. You could throw on a call broken wing butterfly in SPX way further out of the money and collect $200 or $300. And if we do get the sell-off, you can turn that into a symmetrical butterfly and keep that credit or a majority of it. I've been doing that with gold futures this whole year, and it's been a really good trade. So that's another alternative. Like, get a little directional, but still collect a credit, have no risk to the downside. It doesn't have the same teeth as a diagonal spread or even just like a short contract would if you're using like a micro futures contract. But there's plenty of ways to play this if you want to throw on some new neutral to bearish trades.
Okay, so broken wing butterfly is a little bit more of an advanced options strategy here. You're not going to have strikes that are equidistant from the midpoint. Do you mind just breaking down why, under what situation someone would want to put on that broken wing butterfly and how they would actually apply it? And I know, for what it's worth for the people here, you can go to tastylive.com and look up our concept strategies. This is in there. But Mike, while we have you, could you take out your whiteboard, so to speak, and explain it?
Yeah. So if you're in the GCV contract, the 23-day contract, and you pull up that options trade. So basically, the one I have on is buying one of the 3480 calls on the upside.
3480. Mm-hmm.
Selling two of the 3500s. And then buying